invested in the stock market. One other thing, and in this, eBay was sort of a pioneer, working a lot with regulators and with the political sphere to make sure that the laws and the regulation are set in a way that helps the company grow. Again, in the previous conversation, there was a lot of talk about regulations. I can only confirm that for companies, a stable regulatory environment, a unified regulatory environment is fundamental to enable growth. Fragmentation puts a lot of burden on companies like eBay previously, now like Vinted. Dealing with different sets of regulation in every market where you operate ends up being extremely complex. Even in a completely virtual environment like the one where we operate, just the amount of customization that we need to do in our product for each and every country becomes very quickly unsustainable. One interesting thing, and it was reminded to me by the previous moderator as we were chatting before, companies like eBay before, like Vinted now already, have a great role in creating a system around them. eBay was one of the pioneers in the internet space, and the number of talent that got out of that company and that started other companies, the names like Abound of people that have been ultimately founded and grown by people coming out of eBay is massive. And Vinted can play the same role here in Lithuania. I know that there are already a few startups that were born out of people coming out of Vinted. So the role of a Kickstarter of a system is very important. When it specifically comes to the discipline of being a public company, it's very important that you have the right skills, the right technology, and you hone the discipline going forward. Again, in an environment like this, for me, the most important thing is the capability of a company to create professionals that then can take other companies to be public and to just create a system around them. So I think those were the key things for me on my experience.
So now we move back to Vinted, and let's for 1 second imagine that you are doing a pre-IPO roadshow. Mm-hmm. What is so attractive about Vinted that investors should buy your stocks, and how they will make money?
So Vinted is a unique company. You probably hear it from my enthusiasm. There's a reason why I joined this company. Number one, its mission is just so important in this day and age. We heard before about green investments. The mission of Vinted is to make second and first choice. It matters a lot. I'm a parent of teenage kids, and I would love for them to be able to live in a world where you can breathe and doesn't always rain or there's 40 degrees. So in that framework, really Vinted sits very well with what is happening around our society. From an investor, we are growing. The company has been growing very rapidly. We're still growing extremely rapidly. I won't be quoting any numbers. Some of our numbers are public. We are, since last year, we're fully profitable, which doesn't always happen. A lot of technological companies promise a lot on growth, but they can't achieve profitability. We're one of those few examples where we are both growing fast and we are profitable. We operate in a market that still is in its infancy. While a lot of commerce have already migrated online, second-hand hasn't so much migrated online, and so there is a wide market in front of us, and we have big opportunities. We have a clear vision. The company is run extremely well. A couple of days ago, I know you were talking with our CEO. He really set up the company to achieve great goals. We are very ambitious. So we don't want to play small. We want to play big and be a European champion, a European technological champion. again, the Draghi report has been called out repeatedly, and the need to have European technological big companies, we certainly want to be one of them. So all of these things, I'm sure, would make an investor extremely excited about buying into a company that has big ambitions.
So let's assume, if you decide to do an IPO, you have to grow more, and you said you grow fast. And despite the fact that you're profitable, you're probably not just going to grow out of your own internal profitability. How are you planning to finance your growth in the sort of shortest perspective?
Yeah, so we actually are in a very lucky position. We do not actually need to raise capital right now for growth. We have a good sized cash pile, and that cash pile is growing thanks to our profitability. We can finance what we want to, the direction of growth that we have in our mind. We have started to take out a revolving credit facility. We closed one last year. It was more to test the waters than for a real need. We work with BNP Paribas and with ING. We have a 50 million euros revolving capital facility at our disposal, which we do not use because we do not have the needs now. In pure line of theory, there might be events you mentioned, sort of if we were to do something inorganic, so a big M&A. If that were to happen, of course, we have a couple of avenues. We can raise further capital through our existing investors or attract new investors. We are in that good position that we're kind of being more and more visible in the market. So we receive a lot of inbounds from investors that want to get on our capital table. So if we had an opportunity and that exceeded our cash availability, I'm sure there would be people that would be willing to chip in. We could also, hopefully, be in a position that banks would be able to extend credit to us in a much easier way than it's been in the past, because we've been proven now repeatedly that we are a profitable and growing company.
So when you talk about investors, obviously investors have one thing in common, and that one thing is return and exit.
Indeed.
And what are the strategic alternatives you are considering to deliver that to your investors?
Right now, to be completely honest, right now our main focus internally in the company is to operate a business. We have a lot of avenues in front of us for growth. And we can talk later about what they are for sure, but if you start paying too much attention on exit and your time is limited, the managerial span of attention is limited, you risk forgetting that you need to run a business. That being said, we evaluate all possible actions. We can continue to run to change the investor that we have on our capital table. We can run secondary sales if that is of interest to our investors that want to monetize, particularly early ones. But of course, we are constantly evaluating the possibility of doing an IPO. It doesn't mean that an IPO is on the cards. It just means that, of course, that is one of the things that we always continue to consider. And in that framework, then we spend enough time to internally be clear what milestones, what goals, what kind of story we need to achieve before we are ready to do an IPO.
In addition to the fantastic growth story, to be potentially listed, you need like accounting, audit, governance, compliance, transparency, all these, boring things, but unfortunately, inevitable. Do you have any internal project, and is that underway? And how does it work with your, vibrant tech culture?
Yes. Those boring things are one of the reasons why Vinted is paying a salary to me. So they might be boring for some, they're certainly not boring for me. Look, a couple of years ago, we actually, well before I joined, the company already ran a process which is known as IPO readiness assessment. We called external consultants that looked at broadly speaking, the way the company is run, and in particular the way my organization, the finance organization, is run, because it plays a central role when you are a public company. I'm very pleased. The results were very encouraging, but of course there are always things that we need to improve. There are a few capabilities that, particularly as you get closer to IPO or you become a lot more visible, you need to build, for example, investor relations. But also we want to make sure that internally we are as efficient and as sleek as possible in all the processes that we need to run. That is partly because if we become public, that's the message I'm bringing inside the company, our tolerance for mistake or our ability to be a bit imprecise drastically goes down to zero. We need to be super sleek, but also because in general, any company benefits from running state-of-the-art processes and technology. Within that, we are a technological company, therefore you would expect that we are very focused on leveraging technology as much as we can, which is exactly what we do. We look at all opportunities that we have to improve our efficiency metrics, to have the maximum output possible with a minimum amount of inputs. We try to automate as much as we can, and a lot of attention then goes into all controls to make sure that what we do is compliant with all regulations, and that we make sure that there is that there is a strong systematic way to avoid anything bad happening inside the company. I would say I'm blessed to work in a company that has an extremely honest approach. Everyone that works in Vinted is a very good person, but you have to have systems and controls in place to avoid that something can go wrong.
Quick turn on the strategy. If you were to consider, obviously we would hope dual listing, but like the primary listing in the US, would you have to be in the US market with consumers? Because now you kind of own the European second-hand market, but you are nowhere near that in the US.
So that's a great question. It goes beyond just purely the IPO. We are now present in 22 markets in Europe, and there's not many bigger markets that are left for us to do geographical expansion. So there is a general question in terms of just business growth, which looms larger than its US presence. Technically, we are present in the US. I think our site runs there, but we don't spend too much attention. My experience coming from having lived in the US, having worked for the US company, having interacted with investors and analysts in the US, they have a massive market and they're human beings, and so they have limited amount of time at their disposal to analyze and understand global businesses. Therefore, for them, naturally, it's extremely hard to understand the business if that business isn't present on the US.
They don't experience it firsthand.
They don't experience it firsthand. For them, still Europe is a bit of a complicated beast. That they're focused on a massive domestic market. So for sure, within our considerations, if we were to go at some stage have a public listing in the US, we would rather have a US business. It's not that it's an imperative. As an example, Mercado Libre is a Latin American company that operates in e-commerce. They don't have a presence in the US. They are only operating in South America, and they are very successful. So there are cases, but they are few and far in between. Certainly, we would like to be there.
A quick step to your interaction with the local community here. You have a e-money license and you are supervised by the central bank. How is the relationship going? If you foresee the future supervision as a listed company, you have maybe some comments about some words. What's the government doing? How is it doing in that field?
So I would start there, but then maybe extend to broader engagement with government and regulatory bodies, tax authorities, and everything. I think we are working, we make a point of being a great corporate citizen. We actually want to be fair taxpayers. We don't try to do anything to optimize and avoid paying taxes where they're due. We are very proudly Lithuanian. The vast majority of our employees are actually here in Vilnius or in Kaunas. We continue to try as much as we can to hire here. And we want to work with regulators and with state agencies wherever possible so that we can help shape the right regulations that enable us to grow in a fair way. There was a lot of talk before about regulations. Our position is regulations are needed, consumer and society need to be protected, but at the same time, they need to be designed in a way to allow nascent businesses or very high potential industries like technology to grow and to not be at a disadvantage against bigger and global, predominantly US players. Back to my origins, I come from a big US company. The resources that they have to deal with complexities and regulations are much bigger than what a nascent company can have here. And excessive regulatory burden really stifle growth. We work hand in hand with a lot of government bodies, and certainly one thing I have learned in my career is much better to work hand in hand and to have a constant dialogue to find the right medium. So I'm hoping that we can continue working that way. As a commercial enterprise, of course, we always evaluate where is the best place for us to be, and the regulatory burden that we are subject to is one of the factors that plays in our decision on where we establish ourselves.
And our regulator has been phenomenal in becoming the most popular e-money license spot in Europe. Hopefully, we have the same kind of vibrancy and creativity in making it work for the capital markets, even though we are in the 10th conference and we are still, kind of moving slowly. But if you had, and we will move to the panel discussion soon, but if you had like one small piece of advice, not necessarily related to anything related to financial regulation, what would you do to help companies grow like yours, and to grow from here?
I would step away from financial regulations. I would say education, critically important, particularly for a technology company. We hire advanced skills. And you have to look at this in the 5 years, in the 10 years horizon. So education, super important. Infrastructure, very important, just like as silly as it is, you and I spoke when we went to lunch together. I live in London. I got only one direct flight from here, and it's not even from the major airport. And if investors want to come and invest into companies, they want to be able to meet with the management team to discuss with them. You have to make it easy for them to come here. So all of this stuff will go a great length to help grow companies.
Good that we are in the election cycle, so maybe some parties will note your thoughts. I thank you very much for your panel, for your fireside, and we will stay on the panel. So if we have time for the questions, you can bring the questions to Maurizio later. So back to you.
Thank you very much. We give you now a big hand. And I will just very briefly kind of summarize what was said. So to connect the fireside chat to the previous one, it has been said that fragmentation puts too much burden. Vinted sees a role of creating a system, role of sort of kickstarting the system as important. Startups growing out of eBay or Vinted, as an example. Vinted is currently working internally to be run as efficient as possible. Since last year, it's been profitable fully. Clear vision, mission, huge ambition, playing big, goal to be European technology champion. Working with regulations, also to shape regulations in a fair manner, working hand in hand with governmental bodies. This is what Vinted sees as very important. As to IPO, it is not necessarily on the cards, as you said, on the table, but we are always continuing to consider it. And among the arguments, we have learned that going to public will make tolerance for mistakes different than previously, and so on and so forth. So we will probably hear more arguments. And let me just bring you all to the panel debate. Oh, and you need to make it an easy way for investors to come here. This is a general and generic advice that is worth repeating, I think. And let me ask some other speakers to join Dovile and Maurizio to the panel. And let me first invite Director of Financial Market Policy Department at the Ministry of Finance of the Republic of Latvia, Aija Zitsere. Let me also invite Head of Investment Banking at Swedbank, Jonas Kvedaravičius. Head of Finance Communication at Enefit Green, Sven Kunsing. So these are the three other panelists joining, and are all of the chairs now full? Are we not missing anything? I think we are not. Maurizio and Dovile are there too. Right, Dovile? That's it. That's it. Okay, thank you.
So we are now a mix of government, corporate, advisory experiences, so we can have a good discussion and then maybe create some progress. I would like to start with you, Jonas. You are the veteran or the champion in the market, where you've probably worked on every IPO that happened here in the Baltics. Can you reflect on the current status of the market and where we are today?
Yeah, so first of all, not necessarily all IPOs, but number of IPOs, to be fair. So yeah, current status, it's like you mentioned that it's 10th anniversary. We are just talking. We have few examples, very nice examples, and we will have colleague here, which I should say that it will be a champion example attracting retail investors in the Baltic states. But yes, we need further development. We need further growth of investor universe. We need new companies to consider and to join our Baltic capital market. So if we look overall, this we always speak about this chick and egg situation. Do we need investors, companies to come for IPOs, or do we need companies and good examples, IPOs to happen? So actually what we can say from current perspective that investor universe is growing. We have in Lithuania, we have something up to 150,000 investors, retail investors who are looking at the market, not necessarily in the Baltics, but yes, they have investment accounts. Pension funds, which are discussed and touched in previous discussions, but they are steadily or quite fast, if we look at the last 10 years, accumulating money. And definitely local pension funds and local fund managers are initial target for potential IPO candidates when they consider to list, and they will definitely be first tier and most reputable investors. In Lithuania, we have 8.5 billion pension fund money already. In the Baltics, close to 20 billion. So it's quite an amount of money. For retail investors, I have checked also the amount of portfolio managed by retail investors. It is calculated up to 3 billion euros, and it's quite nicely split among different instruments. And equities make something like 1.2, bonds making something like 700-800 million euros, and also 700-800 making indexes and related index-related investments. So I should say that shortly that we have investors, we have already nice examples of IPOs which managed to attract interest, managed to attract huge numbers of investors. And we need good experiences, good companies considering to come to the market, and that will definitely ignite and definitely grow our local capital market. Also, if we look at foreign investors, which are institutional investors, which are very, very rare in our market, currently we, MSCI, started to regard our market as Baltic market. All three countries are one unit, which is a very good development. And we are like, now we seen as frontier market, but with introduction of few, to be precise,
How many?
three companies with a capitalization of 2 billion and a free float of 1 billion, we will be just upscaled to this emerging market classification. And what gives that? It gives more interest from index funds, and these funds will be obliged to look at potential companies, IPO companies coming from this market. So we really believe that it is a goal for the Baltic markets to introduce these three big companies to our market. And I believe we have really good potential for that.
Very good to hear that. So I will switch now to Sven. Sven has been mentioned, he represents Enefit Green, which was a fantastic, successful IPO. And you are one of these companies that everybody is looking at to pull the market. So how is the job of pulling the market going?
Yeah, I mean, we attracted 60,000 investors during our IPO. Of course, we were a bit lucky with our timing of the IPO. So we had the great kind of wind behind us from the green investment boom back 3 years ago. And then of course we had the lucky situation with the Estonian market that at the time of our IPO, the number of investors in Estonia, which is the smallest of the Baltic countries, as we know, hit 100,000 or nearly 100,000 investors, and we got 60,000 of them. It actually has been running also these 3 years or most of this period quite successfully. The number of investors actually has been growing. Currently we ourselves count 62,000 investors. The top was 64,000 investors. And how we work with this is that we try to be as clear as possible in our communication, investor communication. If I compare ourselves also to local company or local champion here, Ignitis, then we try to make it a little bit less complicated. The wording of our communication, maybe the of course Ignitis has much more complicated business than we have, but still. And what else? And we of course have also had a lot of engagement with private investors in some business, let's say investment forums, also being sort of present online where the investors discuss things, always being open to the journalists, always trying as fast as possible answer the questions over email or wherever they may come. We do the investor seminars on our quarterly results in 2 languages. All our sort of reports and communication is obviously also in 2 languages, Estonian and English. And we also try to attract more institutional investors, but this has been an uphill struggle actually from the very beginning. And I think...
Can you share a bit the specific examples of what kind of activities do you organize for that purpose?
Yeah, I mean, we visit the investor conferences elsewhere, so organized by some of the regional brokers or regionally focused brokers like Erste conference on annual basis, Wood Securities conference on annual basis. I mean, I used to visit those conferences back when I was in my previous job managing Eastern European equities for I managed some team of equity fund managers for SEB for about 15 years. And we always visited those conferences, and actually also some other conferences by maybe a bit more global houses like, I don't know, Citi or what have you, Goldman Sachs. But what has happened actually over the time, unfortunately, is that over those 15 years, that the interest in emerging Europe and maybe in emerging markets as general, maybe apart from China, actually went down quite a bit during that time. And the investment teams turned more global in their focus. And that unfortunately also meant that a little bit of this institutional money kind of simply disappeared from these smaller markets. And I think the initiatives that the local stock exchange and the local, let's say, sell side is trying to do that to bring, I mean, some larger companies to the market. Maybe also the governments can do their job here to maybe privatize more companies and sell more shares of the existing ones.
We know they need to reach this 1 billion capitalization of the free float, so
yeah, exactly. So
that.
that would be helpful also. Yeah, exactly.
We'll come back to you. So the Latvian regulator has created a new comprehensive market development plan. So Aya, can you enlighten us, and what is the progress there?
Okay. Hello, nice being here and talk about capital market development. I think already our initial interventions from our governor was slightly depressing. We are quite low on the curve at the moment, but it seems we should start finally.
But he said just do it, so that's going to be your job now.
We are doing, and we will be doing. So here we discuss a lot about investor side and enterprise side, so I will try to split things up. If you look at the investor side, we do have investment account framework for tax purposes, and it's been already more than 5 years, and it's quite successful for retail investors, those who are willing. It makes calculating their taxes very easily, and you can postpone paying taxes until the moment you are actually disbursing your capital gains, which is quite favorable framework. We have initiative from central bank on financial literacy strategy, trying to improve the knowledge. What we see in recent years, at the moment when interest rates returned, we have state saving bonds, and that initiative been already existing for quite a while, but it was rather flat. But then at one moment when interest rates returned to the positive numbers, it actually grew exponentially. So it's which shows that there are interest from investor side, even if the actual number is still low of people who actually invest in stock. So, and also what we see is more investor movements from private sector, like we have also our local investor clubs. They do their own events, and so the numbers should be growing. If you look at the enterprise supply side. Then we've had for a few years also the support grant program for SMEs, so that they can get a grant which partially covers their expenditure for listing or issuing bonds. As for small companies, it's much harder to go to the capital markets because their attractive investment is smaller. So that's aimed specifically on this market failure. We have had the actual number of companies which has received support is rather low. I can name one good example is APF Holdings, the egg. So talking about eggs and chickens here, which is kind of a good example of a small company which needed financing, and they actually were brave enough to go to the capital markets. And that's important so that companies now know where to look for money, and the capital markets is on their map, not only the banks. But of course, we need larger numbers. At this point, already in a launching process is IPO acceleration fund, which we are doing together with Lithuania, which was already mentioned, and it's currently in a manager selection process. So we hope in the nearest months it will be able to start operating. And we have another initiative in a central bank, which is Capital Market Sandbox. It's a public-private initiative because there's regulator and advisors, they come together and they free of charge advise companies how to better prepare for IPO or bond. And it also helps financial literacy from the enterprise side. But what we saw from the government side as the last missing point, we need larger numbers. And yes, of course, we managed to achieve the MSCI Baltic Index, but it doesn't alone bring us to the next level. So we finally have in our government declaration clear priorities that we need more state companies in the capital markets. We have done the exercise, actually looking at the companies, and then we hope that we will finally reach it. Currently in the pipeline, probably as a number one is our Baltic. We'll see how it goes. All these efforts take a lot of time, and if we speak about large companies, it's we have to look at their business cycle, of the investment needs. But the most important thing is actually changing perception. And it's on both sides. It's both for investors, to change perceptions that it's not about saving money, it's about investing money, that you have to take initiative. Government will not take care of you. Okay, we will, but you also have to work on your own finances yourself. Nobody's going to do in your place. Especially if you look at all the initiatives on second pillar pensions. And also for the companies, that they know that it's not just bank loans. And currently we have difficulty with banks, for example, but there are capital markets and there are investors who are waiting for those companies. So we need to change this whole perception. And also on the state companies, we have to accept that it's good that state companies are in capital markets, that they're more open.
Well, definitely improves the governance model in those companies. But before we move away from this topic, we have some vibrancy in the high yield bond market now. I want to address this question to Jonas. Is that, like, if you look internationally at the experience of other markets that have developed, is that a stage which, is promising, that from high yield bond we move to equities? And what do you think we need to do to somehow further encourage that?
Yes, so I believe that we already heard that a very important role is for financial education. And financial education, you not starting like solving super difficult math exercises when you are in the first or second grade. So you start from simple and you grow, and later on these more difficult things happening, and it's not difficult for you because you have background, you have education. And this bonds as an instrument, it might be quite understandable, and I'm not very like, it's not easy to say that it's less risky, but it has risks definitely, but overall it might be less risky, regarded less risky. So I see that this high yield bond market, when investor maybe even forgetting that there might be a default, but they put money, they get return, and it's very nice. And I should say even these deposits, which were in the banks for recent years when they generated 4%, they also added to education of the market, because you finish deposit at the current time, it is less smaller return. You are looking for something alternative which will grant you a similar or even higher return, and you turn to another level of instrument, which is a high yield bond. So as I told, education is really very, very important. And in our bank, actually, we have a very interesting education initiative for all 18 years grown-ups in Lithuania. The bank promises to give 20 euros for investment account. And first of all, not everyone coming, and only maybe certain percentage of society is coming and getting this 20 euros, which is given for free. Another area, it's very interesting what they are doing with that. Quite a few are taking out and just going for beer or something else. But it's a very, very small amount of youngsters who are doing that. But others are putting money into investment, and even quite a lot of these young people, they adding money to their investment account and increasing investment. So this is very, very interesting example.
Okay, so now we are in the area of supply, and I will switch to Mauricio now. Like the Baltics have a very, very good brand for breeding unicorns and new business models, innovation now. And somehow investors from around the globe, they find their way to the smallest European countries to invest money, and they actually really positively view their experience here. How do we translate that brand into the capital market? And we know there are some technical problems, such as we need 3 companies to get on the index funds. But do you have any practical advice? Because it feels like if our unicorn founders set their mind to something, they usually move things around here. And like you said, positive dialogue with the government really works. So how do we translate this great brand into capital markets becoming attractive?
I don't know that my answer would be
just be honest,
one
it's fine.
that people can agree. But I would say you've got to go in steps. Actually, what has just been said, I really like it. I think you have to set, as a society, you have to set the right ambitions. I'm still learning about the environment in which I operate, specifically the Baltics, but I just think about what was said before in the pension right now pot. There are 8 billion euros maybe. Yeah. Us as a company, the last funding round that we did, our valuation was 3.75 billion. So you can see that probably we're not the right target. And I think you need to provide significant incentives, regulatory incentives, make it easy for companies that are at a smaller stage than my company to get easy access to capital at risk. At the end of the day, a company goes public for a couple of reasons, either because they need capital or because they want to maximize their own valuation. For a company like Vinted, with the valuations that I was talking before, which of course we want to grow, you need to have overabundant demand. Otherwise, you get like you fail on one of your objectives. So therefore, I would say be extremely aggressive and facilitate all the regulatory requirements that are able to attract companies that are probably in the 500 million euros capitalization. It's reporting, it's compliance. Being a public company, probably he knows way better than I do. It's a pain in the neck. You do it if it's worth it. You have to hire a lot of people that normally would be considered as overhead or non-productive. So it has to be worth worth investment. The less regulations there are, of course, always making sure that there is a minimum threshold to protect the investor, because you don't want to burn a nascent market, the easier it will be for companies to come in. A lot of, I don't know, I was younger, I'm not sure I remember everything, but the Italian boards created a bunch of segments with lower reporting requirements, for example, to make sure that smaller companies could come in and list. Those are the practical steps, I would say, with the right target. I don't think that a company like Vinted is the right target necessarily.
So the laddered approach. By the way, as a M&A lawyer, I can say that if I look at the market every year, out of like top 10 large transactions, we have a mix usually. Well, you have the unicorns attracting funds, which is like the venture deals. They're usually large in size. The other things that are large in size are, corporates, but they are usually acquired as subsidiaries of large European or global corporates. And then you have the family-owned businesses that actually are taken over by a new generation who has great financial education, and they leverage things and they grow globally or regionally at least. And these are probably the companies that could be targeted by us. I would like to switch back to Sven. Sven, you were mentioned by Mauricio. Theoretically, when a company lists, it becomes easier for it to build alternative financing sources for its growth strategy. So how has that played for you? Do you have an ambitious growth strategy, and how do you now deal with your future project financing and corporate financing?
Yeah, sure. I mean, we raised equity, or we had our IPO at the time when we hardly had any leverage. We had some older asset base of wind and solar farms, some other assets, and then I think the plan from the get-go was to use this equity to build new assets with help of debt financing. And certainly we have raised quite a bit of debt, actually about 1 billion or slightly less. Not all of this debt has been taken into use. Some of it has also been paid back. But in principle, yes, we have sort of leveraged up this equity that we got from the public, and the plan was from the beginning to basically grow our asset base, or let's say the installed capacity by about 2.3 times. So we actually at some point even increased that ambition, but then I think the interest rate sort of rise came along very rapidly. Also, which made the debt more expensive. Also, the economics of the wind farms and solar farms maybe are slightly less, let's say, attractive at the moment than they maybe used to be 2 years ago. So maybe this more ambitious growth plan with this kind of capital is slightly, let's say, challenged. We can't grow like 4 times as we expected at some point. But as we are on the market, I mean, certainly we can raise more capital in the future. when the time is right, when we have our current sort of under construction assets operating, when we see that we are sort of paying back debt, new ideas and opportunities come along, and then certainly, I mean, we hope that the market is open for next stage.
And your company has an international strategy. How do you work on that, like internally and externally?
Yes, I mean, we are quite, I mean, we are largest in Estonia and in Lithuania. So these are two main markets for us, quite small in Latvia today, but building something new there. We sold some assets in Latvia last year. And in Poland, certainly, which is the biggest of our home markets, we have some pretty decent growth plans currently of some 350 megawatts of wind capacity that is in very early stage and is probably for the next growth leg later in this decade. And in Finland, we also have completed one wind farm, but Finnish power prices currently are so low that yeah, I mean, this probably is not of the most interesting of our current core markets.
Coming back to you, Aya, you were mentioning about the new project. Can you say a little bit more about the size of it and the impact that you are calculating? How many companies do you think will use the co-investment fund, and then what impact it could have on the market? How does that play out in the plan?
Well, if you look at the amounts, it's you mean IPO acceleration fund. So it's we both countries from Latvia and Lithuania, we both invest 20 million. So it will be invested in companies which are usually in pre-IPO stage together with other investors. And then they will help them to prepare and then either exit or stay for a while. So I can't tell already specific numbers, but of course these are not the numbers which will ensure MSCI emerging market, but it's important initiative to have more companies, and so the size is what it is. And but once this specific investment will be used, we of course can see results and improve. But
that is the normal approach, I guess. For the Baltics, I think what has worked really well is that the government has been growing the venture investing community precisely the same way. And when the first funds appeared, there were like many more following. And currently we have a lot of the fund managers that have started as, government money managers. Now they attract money in the market. So I will get back to you, Mauricio, still. You are a good example of somebody being critical. So can you say, when you do the analysis, what are the good features of the markets that you choose from, like potentially, and where should we from the Baltics be looking at for inspiration? So what would be your listing venues and how they compare, and what are the good sides of the good ones?
Well, number one, so that there's two main factors that you would consider. One is just the size of the demand or the liquidity available there, because that ultimately is supply and demand will drive the prices. The second one is the regulatory aspects, what kind of you sign up to when you go list there. Then there are softer aspects, which are the investors, the analysts that cover the market. We were talking before about the US, are they exposed to your product? Do they understand what you're doing? It makes life so much easier. And then I would also say, and I want to go back also to what I said before, because I think I missed the point. The markets and or in general the countries, what activity of advertising kind of they do. How do they are able also to attract investors? So we were talking before, switching a bit from markets to our country as a system can bring in investors. You have to be on the radar, and you can't leave all the weight onto the companies themselves to go and explain that there is a system. So I think either the markets, if you kind of just look at the amount of advertisement or explanation that American exchanges do, it's massive. So that plays a role into attracting additional investment. So these are, I would say, the key considerations. There are other technical aspects. For example, as a company, we are primarily a euro-based company because we operate mostly in the European market. Do we have currency requirements? But it starts to be very technical. I would say demand pool and regulations.
So during the first panel, obviously, we heard quite a lot about European, capital market union, and there's going to be more uniformity rather than more competition. And this may be one of the reasons why Brexit was kind of popular among some people, knowing the regulation so much. But because you have worked out a plan in Latvia, have you considered what a European Union member can do actually to be attractive in the field of regulation? That's a bit technical question to the Bank of Latvia, but what is it that the government or a regulator can do in one country?
Well, what we have done, like one example is, it was already as well mentioned, but not maybe in detail, is this harmonization in between Baltics, for example, for IPOs or prospectus. So we have quite similar, those national discretionary measures, so that it's easy to do issuing in all three countries altogether. And we can see actually from the market that it's done quite extensively. That's one example. Other example, for example, is this regulatory sandbox, where you help companies to explain how it works. Of course, for EU, we have pretty harmonized regulation, but then you have to see what are those small details where countries can do differently. Also, for capital markets, there are very important issues which are not harmonized: taxation, insolvency, and when we talk about the capital market union, those are quite often forgotten, and single supervision will not solve this. So it's also something, of course, it's an opportunity for each country to look at those specific issues to improve. But if we want cross-border investment flows, this is actually something to be either more harmonized or simplified to achieve capital market union.
So the general belief is that being a small peripheral country, we would benefit from uniformity rather than competition?
To some extent, yes. Yeah, because it was already told today that it's small countries usually invest more abroad, but large investors from large countries do not invest. So we have to really think how we attract this funding. And if, from my perspective, what I see as a citizen, a good capital market union, what I want is that I can invest in whole Europe, and that our companies can attract financing from whole Europe. And that's probably the perspective we should look at it, not just... it's more like cross-border services.
When we speak about retail investors, I think one of the simplest ways to facilitate, cross-border investing is having good apps, that facilitate that. I remember one of these conferences a few years ago, we heard statistics about the fact that when Revolut launched this investment, feature in the app, on the first day they got more as a number of investors than the Baltic capital market had people trading. Of course, amounts were much smaller because they're like young people investing small amounts, but still that kind of says something. They even allow you to buy like a portion of a share. I think there's a fantastic, development going, which is an enabler, and the regulation doesn't harm it at all because it's quite possible to build around it. So, one question to you, Joni, as a long-term market participant, can you make a pitch of why dual listing is good for a company?
So we already talked that here in the Baltics seems there is a limited number of institutional investors. And when we had very, very broad discussion regarding Ignitis and dual listing of Ignitis company, we really understand that if we do local issue, it will be limited to certain amount of institutional investors to come and to see. But if we look at successful IPO, what does it need? It needs a healthy amount of retail investors who trade daily, who do turnover, and of course a healthy number of institutional investors. And from these previous examples and Enefit and Ignitis, we see that actually there is a certain size of the IPO which we should consider as local investor universe candidate, and I believe that something below 200 million, roughly maybe 150 million euro size offering, this is quite good universe to be here locally, because retail investors invest into what they know, what they use, and what they consume every day. And it's nice to be like a shareholder of the company which sends you bill. You pay your bill, but on the other hand, you create value to your shareholding. So when Vinted always was speaking actually that they are not considering a dual listing and local market, I believe two angles very important to consider dual listing. First of all, definitely investor unions. Of course, you said Europe is your home market and clients everywhere in Europe. But on the other hand, you burn here. This is one aspect. Another aspect, vast majority of employees are local, and employee to have shares in local listed company, I think that it's very nice feature. And of course you said that through app you can trade everywhere, but if you part of local capital market development, I think that you are pretty on it, and it will be very, very nice feature.
One question to Sven. There are certain things that a company can do. A company can work with its stock and with its offering, and it develops like a brand for its stock, what kind of identity it will have in the eyes of the investors. I think some recent examples, maybe LHV and Šiaulių Bank, they're working quite a bit with like treasury stock, share buybacks, fixed yield instruments that improve the value of the equity. Do you have a plan? And I think maybe our market not being very mature, we maybe sometimes even lack sophistication from some companies that are on the market to make it a little bit more attractive. So what's maybe your strategy here?
Yeah, we since the beginning have been offering kind of a combination of growth and dividend. I myself, having been around on the markets for, I don't know, 30 years, actually prefer not to invest in dividend-paying companies, because I always see the opportunity. If I need cash, I can always sell, and especially if you have some tax exempt or tax deferred account like investment accounts are, you can always sell and I don't know, either keep the cash on the account, or if you really need it to withdraw some of it yourself, and then decide when you want this cash, not the company to tell you that here is your cash, come and reinvest or
Some
something.
US activist funds would disagree with you. They would say break the company down and pay cash.
Okay, but I actually as I see the audience is, if I may, to turn this discussion a bit other way, I thought that it would be interesting to explode some small bombshell here, maybe something to discuss over lunch or in the future.
Go ahead.
I exited the investment management business and came to Enefit Green at the time when Estonia had their crazy pension reform going. And of course, as a sort of management company, I was, or representative or manager of that company, I was sort of fighting against the reform. But the reform had one good feature. One feature was crazy. Let the people simply take their money and buy TVs and I don't know, fridges or new tires for their car or something. But I mean, the other part was quite sensible actually. It allowed people real freedom with their money. So we also created in Estonia something called pension investment account. And I thought that that's gonna take the market by storm. And I therefore actually saw a little bit dim perspectives for the pension funds, which were meant to manage. But nothing of the sort actually happened. I think even today we have like 100,000, let's say, investment kind of depository accounts for private individuals carrying Baltic shares, and we have 700,000 pension fund owners. But we only have 4,000 or so these pension investment accounts, maybe slightly more these days, maybe 6,000, maybe 8,000, but it's like tiny. But that, in a way, would if we really want something radical to happen to these markets, maybe actually it's worth considering opening up these pension savings to kind of some more self-directed investment. And people have shown, at least in Estonia, that they are not completely crazy. Most people won't even go for that option, or I don't know, like majority won't. And maybe those who actually know what to do with their money and how to manage it, maybe you can also introduce some compulsory diversification rules that you can maybe take away at some later stage. But it certainly would create at least some new investors with constant inflow of money over years, which potentially could also invest in the Baltics, as I have done. I own Ignitis, for example, also on my pension investment account. I own Enefit Green. I own even one Latvian company, which I won't mention because it's tiny. And then I own some global stuff, and then unfortunately I also own some short ETFs, so which haven't worked so well on my account recently. So yeah, you can have lots of fun with your pension investments too.
So to the free market, let people decide.
Yeah, maybe restrict it somehow, not to allow like to take like all of your money, but I don't know, like maybe start with 10% and increase it to 20, and then over time maybe be open-minded about it.
I want to pause a little bit. Actually, it's Yeah, it's very interesting thought, but we can easily measure returns on pension funds because it's regulated, and we get statistics quarterly, and can say that it's small, or it's some politics say that it's very small, some say that it's reasonable, and so on. But how you can measure these 6,000? You don't have, I believe, statistics. And professionals working daily to grow your money in pension funds, they really create value, and they do good things. Few years I was trying to overcome these professionals, maybe with some portfolios. Some years I'm successful, but if we look at longer period, it's very difficult actually to overcome.
Just a comment on measurement. I think I read yesterday somewhere that using AI, one of the European governments mentioned, how people spend social welfare money, and it was like 15 or 20% went into gambling, social welfare. So, I think you can measure everything now. You have so smart computers calculating everything.
But we don't want to call investment gambling, do we? So
No, that's not the point. I'm just saying that people are not smart always, and the free market might create some interesting turmoil. But it's just a question maybe for the break that is coming up, because there will be a lot of discussions at lunch, I'm sure. And we have like 1 minute left, and I'm not sure if we can take questions. I'm looking at Jubilee, the conference moderator now. And if I see Jubilee raising hand, but does anybody want to ask a question or make a comment? Maybe some pension fund managers want to fight their cause.
yeah, I have some former colleagues from SEB in the audience, so sorry guys.
They will fight you during the break.
Yeah,
but
exactly.
you are still speaking. So if there are no questions, I would like to thank all of you very much for doing the chicken and egg discussion. We are going to have food now, so the chicken and egg is going to be outside this room. And I think we've contributed a little bit to the critical thinking of the audience, and that was the goal today.
Thank you so much. I just have a very, very brief question to all of you, or some of you, just to go back to the question of the panel. Baltic IPO landscape, a scarcity of investors or a scarcity of suitable candidates? What can we say? Is it a bit of both?
So actually, I try to say that a scarcity of candidates.
The scarcity of candidates, is that the final then conclusion? Does everybody agree? Or
We can vote.
Yes. Who would agree that it's a scarcity of investors? Would you raise your hands? Okay.
I would say it's both, but more on the candidate side.
Okay.
There's quite room to improvement
So
for
3 to 2,
investment.
yeah.
3 to 2, so it's more or less something like 40-60, right? Okay, so we need that figure because we started with figures that meant to ask the question about the, were the result of 6.5. So now we have 40-60. Let's see what other panel discussions will bring. Thank you so very much. We will now really break for lunch. Come back here at 1. Lunch is on the first floor. So do go down and have a nice lunch, enjoy your lunch, and come back here at 1 p.m., please. Thank you. Welcome back one more time. How is everybody doing? Has anybody had a good lunch? Would you raise your hands for those who did? Okay, the majority. No, not really the majority. Has anyone made someone really interesting and established a very nice contact and they're already very happy that they came to this conference? Okay, more. Okay. This is good. We will have 2.5 hours roughly, and we'll go on without a break. So there will be lots of interesting content, presentations combined with panel discussions. So as you're gathering, without much further ado, I would like to introduce the topic of Baltic debt market. We'll have the Baltic debt market overview delivered by Head of Markets at Šiaulių Bankas, Eglė Džiuglytė.
Hello, everyone. Thank you for joining us today as we dive in a very interesting topic. And it is a very interesting topic, and I have to admit the fact that it's, at least for me, very interesting because due to this topic, I can get my salary in every monthly basis. As I'm a representative of a major player in the market when we talk about small and medium entities and their issuing bonds. So what can we say about it is that we, as a major player, I will try to share my insights, what's happening in the market, what kind of structure we live in, and what kind of challenges and future trends we can share. So I just want to say thanks to my team who unexpectedly decided to join us, and they sit in the back of the audience. So many applause for you from my side, and I hope you will applaud me for even better. So thank you. So let's jump to the topic and start with the major sector there, like our corporate bonds. The Baltic corporate bonds, and how it looks like at the moment for our current issues. So the biggest part of it, the biggest part of like lion's share belongs to financial services, and the major player in this sector is banking. Banking sector, especially local banks, they are the major players in the Baltic capital markets by issuing bonds. And most of them, I have to admit that, frankly speaking, most of them and they are for institutional players. These bonds are for institutional investors. Not many of them are accessible for retail investors. What else? The second player in the market, and well deserved the second position, and is real estate and construction. I'm very pleased and happy to admit the fact that retail, real estate and construction sector representatives, they are more and more active, getting more and more active when we talk about going to financial markets as a source of funding, as a source of alternative financing solutions. So we see more and more of them going to very big projects and trying to get funding through this solution. So they have an option to go to the banking solutions. So now they try to construct their funding plans, comparing and combining both of these solutions. So these names as Lars Elbil, as Kapitalika, they prove to the market, especially for the Baltic market, that they can start developing projects in the first stages with the help of investors, and later for sure going for cheaper banking solutions. And combining these solutions can get more capital efficient. Other players, not many of them we have in our local markets. This is not a very, I guess, not like a sad story to tell, but not many players for investors to diversify their portfolios only when we're talking about local corporate bonds. But energy sector is the second one, and they are eager to get more funding through this solution and coming back to markets more often, especially when we're talking about ESG bonds. They are the major players who try to push the market to a higher standard when we talk about ESG solutions and ESG bonds. What else to share? The Baltic corporate bond market has been like rapidly increasing during the last years, and the main reason is that our market can provide a lot. And when I say a lot, I have in mind the premium for sure, that our market gives a better premium for investors. If we compare it with other markets in the Western European capital markets. So the major player for sure when we talk about bonds and issuing bonds belongs to Lithuania. We have a higher number of issues and for sure the higher number of volume. But this is the case worth to talk a bit more about it. Because when we're talking about numbers, number-wise, from volume size and from number as a number, the major player and the reason for this is our base of investors, where we see our investors. So we have two parts of it. So it's institutional investors and retail investors. And as everyone is eager to hear and eager to get and to attract more institutional investors, what we can say and notice that retail investors in our local markets are increasing their power, especially power participating in these issues. So number of issues shows that especially in Lithuania, these retail investors, they're eager to get and to participate in issues where we can see like for small and medium companies, where they know these names, well-known names, they know the pledges of the issues, and most of them, too, I have to admit that they are for real estate and real estate development projects. Yep. What else? Going to the understanding the structure and how it works, and how our Baltic market and how these bonds represent the Baltic market. The majority, as you can see, when they're structuring these products, these bonds, that basically majority of it are not secured, they're unsecured. And it looks like kind of scary when we look from the retail investor perspective and for institutional as well. But I just want to make a hint and to give you an insight that the part of unsecured issues, this like basically 80% of it belongs to financial sector. To banks, to our local banks, for their capital requirements, and they are kind of popular for diversification reasons, for between investors. But this part belongs to them. The rest of it, they have a pledge, they have a collateral in their issues, and market expects them to have it for sure. Because even though very well-known names are coming to market and they're offering the attractive yields or attractive coupons, attractive terms, but market and investors want to see what's behind the issue. They want to see what's behind the bond, and for sure they want to see something material. And the majority of them, they are going straight forward like to these issues, who belongs and who provides the issue as a real estate issue, and the rest of it is not so attractive from market's perspective. And yes, so we have a lot of issues at the moment, and the number is increasing all the time and has been increasing for several years, and I hope to see it increasing even more. As I mentioned, I have my personal interest for that, but looking at these issues from like a distance perspective, what can I say that the majority of it is for refinancing other loans or bonds, and most of them for sure is bonds. And I get a question kind of a lot. So what's happening? What's the exit plan for these companies? Are they going to go to bankrupt or something like that? Because for some reason, especially from retail perspective, they think that company have to issue the bond, later pay for it and redeem it, and that's it. I just want to say the fact that our especially small and medium companies or large corporates, they know the fact that bonds are not an exception, and you can combine different financing solutions. And what does it mean for them? They don't have to have a plan how to redeem. The plan is itself roll over the bond. So especially the message for retail investors and the rest, that it's kind of normal to issue a bond and to get your funding through this kind of alternative solution, and to have it in mind even later, because you're trying to combine these different solutions and you're trying to combine different funding solutions, and bond as an alternative helps to increase your capital efficiency. I like one of these statistics, like published like a year ago or something like that, about capital efficiency. We talk about it quite a lot, and it was comparison between the United States and Europe. And of course, we noticed that we have a problem, by the way, guys, in Europe, that our capital is not so efficient as we compare it with the United States. And the reason, we have a lot of reasons why, and try to invent a lot of reasons why. But one of the most important was capital efficiency, because in Europe, we are not used to finance ourselves, to finance our companies via capital markets. And capital markets adds a lot of value, increasing efficiency. So we have numbers in Europe, but we have numbers in our Baltic states, and these numbers are even worse. So I'm even more happy to say that capital efficiency comes through capital markets. And capital markets are increasing all the time for last 5 or 6 years. So coming back to the topic, to the structure of the bonds, what else? As I mentioned, refinancing is the main source and the main reason for companies issuing bonds. Another one is project development. And I'm pleased to say that like our local companies as Capitalica, as Lars will be proven the story that it is possible to finance the wall and kind of large projects with the help of investors, with the help of capital markets, and later you finance it with a banking loan, and then like the average cost of project can be decreased, guys, kind of significantly. So this structure is possible, it's doable, and companies one by one are coming to the structure. As a major player in Lithuania, I can share the fact that every single month I get at least 3 or 5 offers from companies who want to repeat the structure, who want to participate in this kind of structure and to get their capital and to deploy it more efficiently. So one thing is to issue bond, and another topic is to redeem it. And I guess even more important than the first one. So timing is everything. And by the way, this is like the most important message from the markets and the most important and loved quote for me, like timing is everything. And I proved it a couple of times. Market proved it to me even more times than I did, for sure. So why timing is everything? When you talk about bonds and issuing bonds, for you it's important to know when to go to the market, or you issue it, you are like a first time issuer, or like you try to roll over your bonds. So the main message for this is that next year is going to be interesting year. 2025 we will redeem kind of significant amount of money, and a lot of issuers will come to the market, fight for investors, fight for money, fight for rollovers. One thing. Another thing, when we see a year later or a couple of years later, 2026 or 2027, we see that distribution between countries, they are getting kind of equal parts, more or less. And the reason behind it is very simple. In Lithuania, in 2025, we have a major part, and the reason is that we love very short bonds, short-term bonds. Lithuanians, they prefer to participate in real estate development projects who issue at least a year or the most 2-year bonds, and they are maturing quite often. But we have like a break even for between investors and issuers. The reason behind is interest rates. I guess it's not a surprise that we are living in the interest rate environment where interest rates are decreasing and expectation for them to decrease further is even higher. So this is the case. For issuers, it's okay to issue bond for a year because they expect to see interest rates lower later and refinance it with a shorter term and lower rate. For investors, it's kind of okay because they prefer to have a lower bond. They need to see a cash flow, like an actual cash flow, in order to trust the product. Another thing, we have a lot of risks around us. So they try to manage and mitigate this with buying these short-term bonds. When we talk about other countries, Latvia and Estonia, they prefer longer-term bonds. The reason behind, because they prefer more institutional investors. And institutional investors, they don't go for a short-term bonds. They choose at least 3-year bond and above it, for sure fixed interest rate, because it's kind of smart at the moment to invest in a fixed rate rates with a longer term bonds. Another reason, what we see, as I mentioned, next year we will see a high number of redemptions and a high number of rollovers, and we see 2027. So what's the difference? Because the amount is quite similar. I just want you to have in mind one thing, that all these bonds, and we are living in a very high interest rate environment, all of these bonds, they have specifics of their own, and one of the specific is call option. The one I love the most. So these issuers who decide to go for a longer term, for sure, most of them, they try to combine the bond and to put a call option to the structure. And even though we see that 2027, a lot of redemptions are coming, most probably these redemptions will come to 2026 or even 2025 because they will use the call option. So the number is not the way we see it could be much higher. So we wait for it, and I truly believe that next year we will see a hunt in the capital markets. Yes, hunts. And what kind of hunting we prefer when we live in the capital markets? There are two types of, especially from my topic, from my profession. I have two types of hunts. One is for issuers, and other is for investors. And I work for both of them and try to combine both of them and to find the way where they meet each other in the most desirable way for both. So what can I say from the issuer perspective, and the reason why I'm so happy to see that capital markets and the power is increasing quite rapidly, because when we see from the numbers and ability and access, small and medium entities to access to funding, in Lithuania and Latvia the number is kind of critical, I would say. The access is so low, and compared with average of European Union, it's significantly lower. So capital markets, even though they know that it's not a very popular solution, but it's getting there. And the reason for that capital markets can provide an access to funding, access to easier funding and more flexible funding. And our entities in the Baltic region, they are trying to adapt it and to find it and to love it from the perspective of funding. Another data one I want us to show you is our households. So as I mentioned, I try to combine both of them. So our households, the number of them holding debt securities is kind of low. But when you can see these three Baltic states and the three countries in the Baltics, we see that the number, for example, Lithuanians, as I mentioned, the market, especially bond market in Lithuania, is kind of active and leading and taking a leading role in the Baltics. And the number increased and decreased quite significantly due to COVID, due to, I would say that, nervous situation what to do next, and they wanted to hold their money kind of closely and choose to go to deposits, and for sure increasing interest rates encouraged them go to the deposits. After a year, a couple of years, they realized that premium in the bond market is more attractive, and kind of, if you're an investor, you're kind of a positive person and you're optimistic, because one way or another you believe that everything will be all right. So they came back to the markets and increased the volumes even more. But when we compare the debt securities in the households accounts, we see that European Union, they have much higher numbers. So we have kind of optimistic and kind of, I don't know, a kind of right way and right pattern to go in order to reach these numbers, because in other numbers we are trying to seek this. What else? I see that I have not many time left because I want to share a lot of things with you, but I want to share a couple of them, like very good examples from the market. And the main message, what I wanted to deliver, is that, okay, we talk a lot about institutional investors and their buying power and their investors' power and their right to push companies in one way or another, to one direction to another. But the most promising thing from my perspective is our retail investors. Why? Because they are participating in these issues even more. So one of the example is Šiaulių Bankas. In spring, Šiaulių Bankas decided to issue a specific bond issue for retail investors as well, including them as well. And participation rate was incredible. We reached oversubscription close to 4 times. So we wanted to collect 25 millions. The demand for investor was above 100 million. So what we needed to go to retail investors, and retail investors showed that they have their bargaining power and they have their buying power, and they are eager to invest. And this example is one of how to motivate investors to be in the market, to raise up the market. Other example is our beloved company in Valda. Why it's beloved? Because this is the example I try to show to everyone, because how to work properly, how to test your place in the market. So they decided to raise 10 million via bonds. And to test the market, what they did, they set a new level of coupon, new level of interest, and a new level of price of funding from investors. So we have a new record, is 7%. So no one up to now reached this level. And what does it show? It shows that company is very valued from an investor perspective, and investors agree to get a bit less from price-wise perspective in order to get the security. And when they know the name, when they know the company, they trust them. They prefer to invest and they believe in the company. And oversubscription was significant as well, close to 3 times. And another name I wanted to disclose is another company which belongs to in Valda, one of the biggest funds. It's Fern Group. They decided to go to the markets, and as you can see, participation rate close to 100% of all of these investors was retail investors. And the interesting part was that the company decided to set the price via auction. So investors could choose the price in the range between 8.5 to 9.5. And they choose middle. So what does it mean? That retail investors, they are eager to invest and they are ready to push price even down for the good investments. Yeah. Another thing to share is especially when you're thinking about raising capital for capital markets, and the main question I get, like quite often, in which kind of range I should think when I think about interest rates, what the cost of my debt should be. So different sectors, they have different ranges. The widest one is financial sector, and the part in the market is the biggest as well. And the reason behind why the range is so wide, the reason behind is one, that this sector includes 2 parts. It's a banking part, which goes in the lowest part, and non-banking part, which includes fintechs, financial sector representatives who are not banks or want to be banks someday in the future. So the range is so wide because the risk part is very different and very wide. Other part of like with a very wide range, I would say, is real estate and constructions. The reason behind is exactly collateral. Companies with a good collateral, with entities land pledged to the bond, they can raise money at least above 10, even below 10. A recent examples show that they can reach below 10% of annual return. But these new developers, without a proper collateral, without a proper pledge, they go a bit above. Even though we live in a decreasing interest rate environment, real estate is a totally separate part. So investors, from investor-wise perspective, they say that interest rates should be kind of high, above 10. And even though interest rates are decreasing, like a base interest rate, they are decreasing, they're not willing to accept a lower price for real estate developers. Sector-wide shifts, as I mentioned, risk premium. So risk premium during specific periods, during specific times and specific events, it changes quite a lot. But from our local market, which gives you diversification for investors and which gives like a stable condition, I would say, even though we think that our markets are very volatile, it's not. And our bond market shows that during specific periods, volatility in our market, when we talk about risk premium, is kind of low. So it's kind of fixed, and we know what to expect when we're talking with issuers and investors. Yeah, so challenges, as I mentioned, and as I promised in the beginning, that I will give you some insights about challenges, and for sure I will give you some insights about trends. So challenges, as we live in our local markets, we understand that it's kind of okay, and we accept these challenges, but the biggest challenge for us is small market size. It's kind of hard to attract international institutional players due to a couple of reasons. One of them is liquidity, another is small market sizes. And these, another like geopolitical risks, macro risks, is not so important. The one is liquidity. And for institutional investors to get it, you have to increase liquidity. In order to increase the liquidity, you have to get bigger players like these institutional players. So chicken egg dilemma, but we're trying to solve it via real examples, via interesting cases, via bigger cases for them. So shaping the future and what trends we can see and what trends we can expect. The major trend I hear a lot is about ESG and green bonds. And when the issuer asks me, is it okay, is it worth it to go to these green bonds, ESG bonds? I have like the one answer. And it works for a whole market that for sure we will get even more push to go to these green bonds, even more push from regulatory part, even more push for institutional investors. But when we come to retail investors and we ask them, is it okay for you to buy, do you want to buy a ESG bond? And all of them will say that, yes, for sure, that's kind of nice, we believe in it, it's worth to do that. But when you ask, are you ready to pay for it? Or are you ready to get a bit lower interest in return for it? All of them have the same answer. No, it's not the bargaining we are playing, and we're not going to do that. So for the issuer, for sure, they have a push from regulatory part, but investors, they prefer to stay, they don't care about the green emissions, they don't care about the ESG, they prefer the pricing better. Other reason other trend I want to disclose is a real estate domination is going to keep the way it is. From the flow I can see, especially from the flow coming to and considering bonds as an option, as a funding option, what can I say, that there will be one of the most player in the market in the future as well. The next trend is increasing reporting, and a bit like a standard increasing standard of reporting. This is the topic I love the most, because I have like my personal target that in the next year and year before and after, I try to do one thing, to encourage companies to come to public offerings more and more. And 80% of my issues will be public offerings to give opportunity to retail investors and for sure for institutional investors to participate in it. One thing is participation rate. Another thing, I want to increase the level of trust in the market. I want to increase the level of and the standard of reporting. And this is the way how we can do that with the companies. By going public, by increasing reporting information, by increasing the standard of it. So thank you a lot. I somehow managed not to be in time, so sorry for that. But I'm glad that I had an opportunity to talk with you, to share my insights as a bond issuer, as an investor as well. And thank for my team who sits in the back.
Thank you so much. Before you sit down on one of these chairs, I just want to double check one minor aspect. When you have listed out the trends in the Baltic capital markets, is the trend of retail power increasing, retail investors becoming more active, and something that you have singled out several times, is that going to emerge, continue to be emerging as a further trend in the future as well?
I believe in it because, as I mentioned, real investors, they are getting more and more active. And even our recent issue shows that they're getting more power, even more power to bargain the margin or bargain the interest, the return. So the listed oversubscription shows that as well, confirms that they are more involved in the issues. They want to be, they prefer to participate in more and more issues. And I have one thing to share, that in July, we decided to take a break from all of these issues, because we have every single month, we have one or two or even more issues, and decided to take a break for people to rest a bit, because we're working kind of hard. And investors, like after a week, without any notice about a new issue, they start calling us, like asking, do you have something else? Are you closing your business? What's happening in the market? Is something wrong? So no, everything is fine. But yeah, they are getting more and more involved, and they deciding to put more and more their money to investment side, not only for saving side.
Okay, thank you so much for that answer. Do take one of these seats, and you will be joined by several prominent speakers. Member of the board of the Bank of Lithuania, Simona Skriepšta, head of investment banking at Signet Bank, Edmunds Antufjevs, as well, co-founder and partner at Wallace, Joanna Baublytė Kulvietė, and the panel titled Baltic High Yield Debt Market, Is Yield the Answer? Being moderated by fund manager and member of the board at Milvas, Tautvydas Marčiulaitis. Let's give them a big round of applause and welcome them on stage. Thank you.
Ready, set, go.
Hey, so thanks for being here, guys. And okay, let's start. Well, we have this question, is yield the answer? So let's go for it. I mean, for the last at least couple of years, we've seen extraordinary growth in local debt capital markets, I would say. And well, do you believe that yield was the answer, that yield was the thing that ignited this, growth? Briefly, one sentence, all of you, start.
Does it work?
Yeah.
Perfect. So yes, the yield is one of the answer. Another is inflation. So when you see inflation up to 20% or even above it, you have more and more motivation to invest and more motivation to seek for a higher yield. So combining these two aspects, yield was an answer combined with inflation.
Simone?
It was the answer. No, definitely one of the answers, but I wouldn't over kind of stress this trend, because we even saw on the slides that even before COVID, we saw a trend upward, and we had very low interest rates at that time. So I guess it's not only the yield is the answer.
Well, from the investor perspective, I think the answer is yes. That definitely, the double digit, what's available on your screen, that definitely drags an attention from the investor's perspective.
Okay, and from my perspective, yes, perhaps this is the answer why it helps attracts investments. But as a lawyer, I think I'm more concerned on the risk side of the thing, and I believe we'll discuss that later on.
Okay, so as we have already answered the main question, and that's all I had prepared. Thank you for being here. Anyways, let's go. So, Simone, well, this rapid growth, of course, everyone is happy about, growing capital markets and etc. We heard quite a lot of stuff about, capital markets are good, we need them. But do you see some risks in this growth and some opportunistic elements?
Well, a short introduction from the macro perspective from my institution. I mean, it's not only important to have a growing capital markets. I think it's essential to have, and the recent Draghi report very vividly illustrated that. Among other reasons, underdeveloped capital market is one of the reasons why Europe and Lithuania, of course, is lagging behind China and US. And actually, this report was pretty gloomy that we have basically no chance to compete and to be productive if we are not delivering, including development of capital markets. So I guess it's very important. And it's nice to see that the bond market is accelerating and growing, like Latvian governor vividly, described. A little bit of something is happening in this market. So that's a good sign, and many reasons for that. Higher yield, of course, one of this, but also I think companies are finally finding bonds as a attractive way to finance, and I think when you look to the yield, of course, bank loan is a bit cheaper, and you can stop here and go for the bank funding, but if you look to bond funding, you also see quite a lot of advantages, and we see from very companies that if they start issuing bonds, their bank funding is getting cheaper, and they have more flexibility, less constraints, and many other benefits. So yeah, it's a positive trend, but I should also say a word on risks. We all very well, there is no free lunch. So of course, high yield bonds are more risky bonds. I guess the risk is connected exponentially with rising bond yields. So yeah, investors should be cautious, but in general, I think it's a very positive development.
Jana, you said that you want to talk about risks, so maybe you have something to add to this.
Well, I think we will be discussing more on the positive side, but if you want me to jump straight into the risks, I can do that. I think there was a very clear message from Egla's presentation that there is increased participation of retail investors, which I guess we are all very happy about this. And if we talk about risks, perhaps we have to distinguish the bond issuances that are meant for professional institutional investors and retail investors. So as professional investors, they are adults and understand the risks perhaps way better than the retail investors. I think we should talk a little bit about the role and about the importance of the professional parties involved in arranging the retail bond issuance. Well, the retail investors may not be that sophisticated, but that's why we have a bank or investment firm that is helping the company to raise capital and creates the opportunity for the investors to invest. And actually, the professional party is key, and it's in its hands to make sure that we kind of maintain confidence in this market. They have to think about many things. They have to make sure that the process is due. They have to make sure that it's compliant. They have to structure the deal well. They have to think well, to whom the issue is meant. They have to think well about the terms and security and whatever other covenants. They also have to do their own due diligence. They are responsible for what they are selling to the markets. And, we see what is the standard of due diligence in international bond offerings. The standard in high yield bond offering is, well, you can comment as well, in my opinion, it's rather low. And here comes the risk. I think that if this is not managed properly, the risks are even higher.
Okay, I believe some shots were fired at our investment bankers regarding their processes. So can you comment from your side? And in general, I mean, let's speak about bonds for retail market, because for institutionals, I mean, nobody cares about these institutionals. I mean, yeah, but yeah, but for retail market, how do you see your place in the due diligence and basically your ultimate responsibilities if something goes wrong? Edmunds, maybe you can.
Yeah, sure. So obviously, it's hard to compare our bond issues in terms of the size. If you do, the 200 mil euro bond and the costs involved in that, and even if you look at the Nordic market, the usual bond issue like for maybe 30, 60, 80 mil, and obviously that also gives a more room for the cost base. But when it comes to, for example, in our example, we do this due deal from the bank's book perspective. So we don't just package the deal and sell it to the clients. So we usually run through our DD, but it's effectively like a credit DD. Are we willing to take our own prop books money and invest in this particular bond issue? And if that decision is positive, only then we can move forward with the deal, sign the agreement, etc., and to work on the structure of it. So that sort of covers a bit like how do we view the projects and evaluating from our perspective. But maybe just before we turn to Egle, from this retail angle, I think to some extent, all of us are happy about the retail presence. I mean, sometimes I really do feel sorry about the institutionals, and the allocations that you guys are getting. But at the same time, this euphoria from the retail market, it also created a lot of tractions of, bond fund creation. Okay, maybe they are smaller, they're getting into the market. Okay, the market is hot. This is why the investors are being, this infrastructure is being created. But I think in like a long run, that's a good sign, because yeah, let me switch. Yeah, I'm switching from retail to the institutional books here, but. Yeah, but I think in general, like it's a good sign also for the institutionals, because I think in the long run, counting your the whole deal on the retail demand is very difficult. And like you show this book development graph, we know that the retail comes in like the last 2-3 days. So it's with the institutionals, you can at least get the feeling, you get the commitment, you can shake hands or whatever, and you can know that the deal will happen. And we need to, to squeeze the yield a bit more or something like that. But with the retail, it's like you never know, and you can only guess it. It's very liquid.
Do you want to add?
For sure, I always want to add something, at least. I'm very scared to speak publicly. I know the fact that when I will go out of the stage, I will forget everything. So this is the reason I can speak whatever I want, because I will forget about it quite soon. So please don't record it. But coming back to the topic, when we talk about risks and how to mitigate, I love to say one thing, that when you're afraid of wolf, don't go to the forest. One thing, and we don't have like a duty to eliminate all kinds of risks, because the high yield represents the risk. We have to have in mind that our investors, they are kind of smart. They are not so vulnerable as we think so. One thing, we have a regulation for that as well, how to protect them, how to inform them. And the key for this, especially when we talk about retail investors, from my point of view, the key for this is to disclose the information, to be able to say, not like actually saying, but to have in your mind and do your due diligence in order to be able to invest by yourself, as Edmund said, that you should truly trust the company and work only with these companies you believe in, and not like, and you truly believe that you can raise capital markets and raise capital markets in a competence level, you can raise capital markets in a reporting level as well with these kind of issues. So I believe that we try, when our market evolves, we increase our reporting as well, we increase our standards as well, in order to provide better products, in order to provide better issues, and for sure that would be accessible and acceptable for institutional as well as retail investors. So market evolves all the time. So I'm kind of happy to see the increase in the markets and the participation rate of issuers and for investors, because I know and I truly believe that market will evolve and will get better with every single issue. So maybe this is the case. But mitigation of risk, disclosing of risk, disclosing of actual risk to investors is necessary and is very important. And the message for market is that, by the way, I love, as I mentioned before, I love public offering deals. The reason for that, disclosure is much higher. And I try to educate by myself and our Sugar Bankers try to educate our investors, and like not only our investors, that you like higher yield is exactly higher risks, that you should understand what kind of risk you accepted the yield. One thing, another thing, please don't take a shareholder's risk with a debt security. Have in mind that you're buying a debt security means you have to have a return of debt security, not like as in very high ones for like equity risks.
Okay, we'll definitely come back to, well, examples or stories about things going wrong and, what happens then. But now let's get back to, this, growth. And I've been hearing today a lot about, the need of institutionals coming over here and, investing in amounts. And I've been hearing that for the last 5 years, despite institutional demand from, especially outside, being very low. Market has grown. So do we really need institutionals? Are we actually at that level that we need institutionals, or can we fund everything with retail and, own capital? What do you guys think? Maybe Edmunds.
The answer is straight yes, because as I noted earlier, the retail money, it's fantastic way of attracting capital, but it's unpredictable. So whatever happens in the market, I don't know, there are some 2-3 bad stories in a row, the whole retail is exposed to that. They just put a stop button and they're stop investing. With the institutionals, they have like a different investment horizon. They have a different risk perspective on that. So like we need institutionals for sure. Whether we need like foreign institutionals, it's debatable, because I think that the market is sufficient enough, and I think the corporates that we cater here, they're usually those corporates that can do Eurobond type of deals. They will anyway go abroad, and they can attract this international investor base. But like a smaller SMEs, I think institutionals plus the retail can definitely cater these companies here locally.
Yeah, sure.
I can add something. Definitely. I mean, scale is everything in many business areas, and I think it's the same here in bond market. And again, this painful example for Europe, the US, the pension fund assets to GDP, 180%. And in Europe, we have 30%, so 5 times lower. In Lithuania, even pension funds are growing and now exceeding 8 billion euros. It's still 10% of GDP. And we see what happens. The largest companies, the fastest growing companies need to relocate to US in order to expand globally. So definitely institutional investors are key in any capital markets development. It's also important for bonds, but I think we also see some positive trends, both from retail as well. Number of retail investors, again, it's quite a remarkable growth. Last year, Lithuania experienced 75% growth in terms of retail investors in general into financial products, which is exponential growth. And I'm sure this year we will see again quite a leap due to some active market players. But getting back to bond markets, yes, I think institutional investors are key. And again, in Europe, when we see to saving rates, they are pretty much the same compared to US. People save same amount of money, just they keep it in deposit forms or real estate, and kind of the money ends the story, or just goes in the form of bank lending with all the limitations, which is natural for bank lending.
Okay.
I can add a bit, like when we talk about like chicken and egg dilemma, and we say that we need a higher quality issues, we need a higher quality of evaluation of these issues and participants. The higher quality comes with institutional investors as well. They are part of it because they have their own requirements, higher for sure. They have their own due diligence systems and so on. So when we want to attract them, we have to provide higher like medium-sized issues at least, and higher standard of reporting, higher standard of quality, higher standard of risk mitigation. So in order to increase the whole level of capital markets, we for sure need institutional investors because they are a power, they are a very strong bargaining power when we compare what we need or what we don't need to provide to these investors, especially from a legal side as well. Then they have their own requirements. When we increase the level of this, we increase the level of whole capital market even for retail investors as well. So without it, we are kind of in a like deep west markets all days, but we want to develop. And without these huge funds, without their huge funds, their huge investments, it will take much more time than with them.
Okay, I get your point, but I've been sitting on 5 mil during whole summer with no one showing me any kind of bonds. So, whenever I speak to guys, in Sweden or whatever, and they want to come here with billions, it's still, that was my question, basically. Are we ready for that? Are we actually ready? But okay, I also would like, them to come here. I'm inviting them. They're just not coming. But, Jana, maybe we've spoken a bit about the differences between local market, European market, and you said that the standards there are better. So what do you think, we could start doing, preparing for those foreign institutional investors? What do you think is necessary to be done?
Well, so on a broad scale, I think that we have pretty much everything, at least from the regulatory, from the legal side. You can structure whatever deal you need to. And I think it's more like a commercial or a business issue or interest that is needed. Maybe touching a bit on politics, and we've heard in the morning session a lot about fragmentation across the EU, and I couldn't agree more. I think we even have quite a fragmentation across the Baltics. I could start from, the legal systems that are same but different. Well, it just happened that at the moment we have one case where we have a Lithuanian issuer, a Latvian bank, and a Estonian bondholder trustee. And we're still exercising. It's a very, very small issue, but a lot of room for lawyers to debate. But the outcome is not very good, actually, because we still have obstacles that we have to overcome. And one maybe to mention, or maybe two to mention, is in Lithuania we have this specific requirement that there has to be an agreement between the issuer and the securities accounting manager. And for a non-Lithuanian bank, that's an issue because they need to involve someone who can take care of securities accounting. That means that they have to disclose their investor details to someone else who is perhaps a competitor. So this is something, it's a bit technical, but it translates into a kind of quite important business issue. Another thing that I wanted to mention is the collateral agency. We all understand that security plays a very important role in risk mitigation, and we quite often have secured bond. The problem, and again, a particular legal issue that is that if we do have an issuance where we are having a bondholder trustee that is required under Lithuanian law, all is good. I mean, the bondholder trustee also holds the security for the benefit of investors, and that works pretty well. However, if we have an issue that is exempted from this bondholder protection regime because it's meant to qualified investors or maybe just a few of them, we have a legal issue that we cannot create a collateral agency that works fully in all respects. We have to rely on the civil law, civil code concept that was meant for more perhaps syndicated loans, but not really the retail or larger bond issuance scenarios. And this is something that might be fixed. Also, it was already mentioned, taxation differences, insolvency regimes that are not harmonized, and perhaps you could think of other things as well.
Okay. Simone, are you working on these issues?
He's buying it.
Of course, of course, and it's we are, I think, all institutions, Ministry of Finance, and we are open to new suggestions, and we have a special forum since last year, the Capital Markets, Development Commission, where we discuss all these things, and we managed to succeed in some ways. We managed to harmonize the prospectus requirements in all Baltic countries, and that included even some law changes in all 3 countries, and we managed to agree among the authorities, and it was done in pretty fast manner, I would say. So I guess, yeah, we should keep working for the future and start, harmonizing the law as soon as possible. Another thing was a question: what do we need for foreign institutional investors? I think definitely, as always, as everywhere, we need some few good success stories, big companies doing some public listings, and here I look to active investor bankers. I think that's the job of you to convince them to go to the market. The companies which are perfectly fine financing in terms of bank loans, but probably not understanding full benefits of bond finance.
Well, I just wanted to add that the Bank of Lithuania is very helpful, and just a week ago, I think they published some explanations around the investment advice and active marketing and related issues, which is very, very helpful because that gives clarity and also gives some room for the banks and investment firms to act more freely, and the rules of the game are clearer. So thank you for that.
I have to say one congrats, by the way, on harmonizing these prospector exemptions in all 3 Baltic states. Why? Because as a person who's very involved in these issues, I would say that it was one of the most wanted and the most helpful things from regulatory body. Because what can I say from like actual perspective of investors? In Lithuania, as I mentioned, we have a lot of issues, and we issue a lot of different products. Diversification of bonds are kind of high, But what can I see? That more and more Estonians and Latvians, they are participating in our issues, even in our real estate cases, when we can see that, oh, it's in Lithuania, you don't know it, you can visit it, but the participation rate is very increasing. And the reason to this, that we actually unite these Baltic states, unite all of these Baltic countries due to this, due to harmonization of regulatory perspective, due to the same law base when we talk about issues up to 8 million euros. So thanks a lot, by the way. It actually helped.
Okay, so good job. Let's go now from this macro, whole perspective to micro. Let's speak about a company, entering the market. And first of all, over these last, 5 years of growth, Edmunds, what have you seen? Do you see more of, large caps coming out and, just diversifying their capital structure via bonds, or are there more smallish companies trying, to access the liquidity, access the money?
Yeah, for the last 2 years, given the interest environment, but we don't see, a huge inflow of large caps doing bond issues, because it's just, simply too expensive. So they're trying to utilizing whatever, lending facilities that they can have from the banks, from international banks, and etc. So definitely like a no. But obviously those companies that need to tackle the refi, like my very own Latvian Air Baltic. So these companies, you need to go to the market, even though it may not be like the super right time. But you just need to do that to do the refinancing. But yeah, so the biggest push is for the like mid caps and SMEs, trying to do, exactly I was pointing out in the slides, trying to do the refinancing, trying to attract some new capital and to diversify the funding profile.
Okay, and following up on that, small caps, mid caps, more, I guess, of small caps. Is it true that, company goes to the bond market only if and only when bank doors are closed and no one takes them in?
Definitely no. So first of all, you can do like an unsecured bond if your, brand or your financial standing allows you to do so. No bank would give you an unsecured loan for 3 years. So that's one. The second thing, there are some situations where the banks are just not willing to provide the credit because it's just not the right fit. So the most popular being the M&A activities, and especially for the companies that are trying to create this war chest. So you're raising, and we have seen like the EcoBaltia and CleanR. So that's like the top 2, I think, examples for the M&A activity. So they raise the bond to do like create a war chest to do. Then you have the money. Then you can start a bidding war or trying to approach the targets instead of approaching the targets. Okay, negotiating the price. Then go to your senior lender. And then you understand. Okay, it's not enough, and it still takes like 1, 2, 3 months, and then the target is already like not interested. So it's like these situations which can happen, and are happening to the very healthy, companies that can get like senior loans. So these are like top scenarios, but there are like many more, like for the real estate, and others.
Okay, sure.
I would like to follow up a bit on this secured, unsecured thing. I think that's one of the main differences between bank lending and bond lending, and it's very peculiar situation in Lithuania and other Baltic countries. So bank lending is pretty low. In Lithuania, just 15% to GDP. That's one thing. It's also interesting that this ratio was actually decreasing ever since global financial crisis, even including high growth years. So that's interesting, and we try to dig deeper and to understand what is happening, and we see that it's basically impossible to get a bank loan without a collateral in Lithuania. So it's a strange thing, but actually it's not in Europe. 40% of all bank lending in Europe is unsecured. In Lithuania, it's just 5% or 10%. And that, I think, is one of the answers why this kind of bank lending is so constrained. Banks are targeting best clients with a lot of collateral and history, financial history. But that transforms to, you know, negative macroeconomic consequences. We miss some projects which are not financed and built. So bond financing is a completely different story. We saw numbers, you know, 63% unsecured lending, so majority of this unsecured. So I guess, yes, banks should change and they will probably change, but it will take some time. And currently, bond financing is one of the answers to solve this puzzle.
I will add one case. Like I get this question quite often, basically every single day, and I think this is the reason why I'm a redhead, because I'm burning out inside out due to this question. But for example, M&A deals. I see a lot of companies in Lithuania and in Baltics as well. They are very strong companies that they want to finance their need to buy another company outright. So basically, for them, it's impossible to get a debt from the bank in our region to finance M&A deals. So they are not like weak companies, they are very strong companies. They have a very strong cash flow, but as Simonas mentioned, they don't have collateral. They don't have like real estate collateral, because not even all collateral is acceptable for our banks. It's mainly a real estate collateral. This is the case. So they decided they choose to go to bonds, to capital markets in order to get financing, especially for the M&A deals. And as I mentioned, this is the source how to make your capital more effective and efficient when we talk about how to use it. So I'm very proud to say that the increase in capital markets and increase in bond market with its flexibility will for sure make our market more efficient, more flexible, more able for our strong companies to grow even more.
I'm just thinking, is it good or bad that bonds are unsecured? For companies, yes, it's of course an alternative. From the investor side, do you think it's okay for a retail?
I would say that, as I mentioned, when we talk about high yields, you have to have in mind that high yield is not because you have a very nice eyes, and it's not for deposits. Deposit is a very safe instrument that has lower yields and lower returns. High yields by itself means that you are taking kind of high risk. And it should be this way. You're getting a return from the risk. In this case, the risk evaluation compared with the yield, is it correct or not, is the separate question, I guess, and separate topic. When we talk that is it right for retail investors, I think that retail investors are the market participants as institutional as well. And they are getting smarter and they're getting more educated, and our purpose is to help them to reach the stage. Then it would be for them okay in a specific part of the portfolio. For sure, we all try to explain them that it is not okay to keep your all money in one pocket, but you have to diversify things. And our capital markets, especially in the Baltics, I think that they provide opportunity to diversify their portfolios and to take some part of risk, sometimes even higher part of risk, and it's kind of okay for them in specific parts, for sure.
Okay, may I just chip in about the collateral? So meaning that the panel name is yield the answer? I think is the collateral the answer, right? Because when it comes to collateral, in specific, like in Estonia, we as a Baltic investors, we have still an ongoing, bond default case where actually there is a collateral, there is this loan or portfolios that should be valued something, but the investors cannot even get their hands on it, and in like the Luxembourg, Estonia courts, bankruptcy, and so. When the investors invested, they looked at the collateral. Yes, there it is, but it's just it's not like it's not the answer, right? Yeah.
I think I'm coming back to my initial thought. It's not just the collateral; it's the value and the enforceability of the collateral that matters, and the bank is actually responsible for making that this works.
No more answers, Edmund? That's it?
No, I mean, when it comes to the value, obviously, we're not talking about the real estate LTV, 60% for sure. You would get the bank loan for that. When it comes to enforceability, so this is the reason why we like, to have it a local company, local law, local securities, where you don't have these different law intricacies and enforceability. God knows how it actually works in real life. So yeah, I think again, there's no like one right answer. It's just you need to take a look at. But again, like in some cases where you do like Luxembourg Holdco, etc., there are these various law, and when you have an assets here in Lithuania, it's a question to you, like how do you enforce it properly and effectively?
That's why.
Here's the complexity.
Yeah, that's why our local investors love real estate, because you can see the building, and if it defaults, you can simply go and squat in there. Anyways, Simonas, from the regulator's point of view, what? Well, we started an example of, bond defaulting and no one actually knowing what to do with it, how to sort it out. Do you look at these cases and, think about solutions, and do you, try to build some frameworks around it to make the market safer?
Well, I think it's not only the will and wish from regulators, but from the whole community to avoid, painful defaults, which of course very disproportionately affects the market and could be a stain on the market for a couple of years. So that's, I think, from investor bankers to issuers to regulators, the common goal should be to avoid such just failures. Even in this cycle of the market, just the beginning of the growth. Other thing, of course, our role is to ensure that all the disclosure should be done properly. That's our key role. It's also our role to inform investors that they should evaluate the risk and should understand the risk before investing their money. And some defaults could happen. That's part of the game. So it's difficult. It's always, you need to find this sweet spot between risks and rewards. But yeah, looking from individual investor, it's perfectly understandable that he or she, they want collateral because it's higher security. But when we look from the macro perspective, it ruins the whole thing. We see that that's a different product. We have bank lending for that, and some companies won't have funding. And again, US is taking over these companies and growing their economy. So it's a balancing game, and I think we should all try to hit this balance, especially at this stage of the market development.
Okay, I heard lots about disclosures, and yeah, I agree that it's investor who should decide. But looking at how things are developing, all these oversubscriptions, and obviously market is hot, and obviously not everybody is reading those disclosures. I mean, we all know that. Who do you guys think is ultimately responsible for these cases? Is it investors who are too greedy? Is it investment bankers who are too greedy in taking any kind of case and going with it to market? Or is it the regulator who's not trying hard enough to prevent these cases? So does anyone has an opinion on this topic, or you all want to skip it?
Because it looks like we're trying to find who to blame.
Yeah, but I mean, it's interesting now to see all these cases rolling out and just trying to understand where the safeguards has failed, basically. So if we understand who failed, we can make it better in the future, at least in my opinion.
From my point of view, everything works together because it's like in a wheel. You can't say to take one part or another to say that this one to blame or this one has the full or responsibility, and the end user don't take any. I don't think so. I think that like the whole system, like the whole ecosystem works in one way, that it works together, and we have to take from investors' part, from investor side, we have to take responsibility of our own money. it's our own money, it's our work, it's how we earned it. So we have to take it. We have to be involved in these cases. We have to read documentation, by the way. I have to admit the fact that we get some calls and some investors who say that, oh, I want to invest in this and this and that. And they say, and we ask them, do you know what kind of risks do you understand what kind of risks you take? Have you read the documentation? And when they say it's like, no, like, okay, at first do this. At first, at least help yourself to do this, to read, understand, and ask questions. And always encourage them to ask questions. I can ask questions as well. I can ask questions about questions you should ask. But this part belongs to everyone. Like for me as a banker, I have an obligation to educate them. I have an obligation to disclose information. I have obligation to understand what kind of risks they can take and what kind of risks they understand and what kind of risks is okay for them or not in one case. But as an end user investor should do the same as well. From the regulatory part, they of course trying to protect them in all possible ways, but it's kind of hard to protect person who don't want to be protected. Maybe this is the case, and they try to do the best. For sure, I can be the witness of it. And as we talked before, everyone is complaining about stronger regulation, stronger requirements. I'm not that kind of person. I'm not in this kind of side. But of course, we have a stronger regulation. We have more work to do. We have to prepare more. We have to have different layers of defense in different various things. But I kind of do want to do this because I care about the market, and I not care about individual investor. For sure I care, but I care about the whole market. The capital markets increase, the capital markets quality will increase, and this is the way, and this is the reason why we leg in leg, hand in hand, working with regulatory, working with investors, working with other investment bankers as well. Everyone's kind of convinced that we are not competing. For sure we're competing, but we are working together in many cases as well in order to make the market better. And for sure we're working with the legal as well, trying to get their opinion and involve them. We're not doing everything by ourselves, trying to get experts in this kind of area and increase the market quality step by step by increasing even our investor knowledge as well. I talk a lot. I think I talk too much. Yes, so maybe this is enough. I will transfer that to another.
Yeah,
Please.
I think when things go wrong, then people definitely read the documents and they read the disclosures. And that's the thing, actually, it is actually in a sense meant for that, because it works and the due diligence process and the due disclosure, it works as a defense for those who were involved. I mean, if you have properly disclosed the risks and someone decided not to care about them, it's not your fault. So you are kind of, not exposed. Let's see.
I would like a bit contradict and supplement, I guess. I think it's very much, like a team sport. If we want success as a ecosystem, in this area, in the development of capital market and particular segment of capital markets, we should be all very much interested that, you say the client, the retail client, probably they don't, read everything. But this is bad. We should look for ways, maybe some executive summary or simplified, ways to make him read the basic, at least the basic information. And if the investment bankers, notice the situation, I think it's very important to take responsibility and try to find, creative ways to solve these issues. And it works for us regulators, and I think it's only if everyone from us will take the responsibility and deliver, then I think we could be more successful, and that's including, of course, lawyers and all the market participants.
Yeah, just to chip in, I think whom to blame? The blame diversification, because let's be honest. Despite disclosures, despite due deals that's happening before the deal, the situation will change. It's still, especially if it's like corporate debt, it's still business. The business environment change. There are some stuff that you cannot control, and even with the senior secured bank loans, they also go default. And in some cases, banks, even like in senior loans, they will not recoup the whole amount. So it's so let's not lie to each other and say that we can like super secure this and make it like a deposit. It will not be like that. So try to diversify as much as you can. Try to maybe give your money if you don't want to spend so much time of looking at the situation and evaluating the companies, give the money to the advisors, to the portfolio managers. They can take the decision for you. And again, it will not be like a panacea. And even institutions have a positions in the portfolio that go default, and it's just a matter of this is how the market works.
Yeah, I would agree, but I think we have to distinguish situations, when there's the risk of business, risk of life that materializes. That's why you kind of take that risk and you have your yield for that, right? But there's nothing you can do. I mean, we have a bankruptcy case ongoing in Lithuania, and it was an unsecured bond, so the investors will not get paid. But there are other kinds of situations when not just the issuer, but also the managers, the bankers, the trustees, even perhaps the lawyers may be involved, and we know these kind of situation has happened even in Lithuania. We had some extensive courts practice on mis-selling, and these kind of things perhaps is worrying even more than the kind of natural causes that of course happen.
I'm glad that you all agree that, the blame should be diversified when we're speaking about retail investors, because when you speak about institutional investors, the blame is never diversified. It's always the fund manager at fault. So, yeah. We have a couple of more minutes left, so I would like to end on a more positive note. Can you guys each, you see the clock, so you have like one sentence each, more or less. Can you give a good example to local investors, guys, think here, what to do now? Well, market is growing, will be growing. So what's your advice for local investors looking into high yield market?
Diversification. And this is the time I will speak less than more. So diversification. Next, please.
Read the information and understand the risk.
Don't be too greedy.
Education in all levels.
Okay, so you were very quick, and thank you for that. Thank you for not needing me for half of the time here. And yeah, so we heard that, market is growing. We are happy about it. We need a strong market, and yes, we need both retail and institutional investors down here. So if you are not investor, please chip in. Please open your bank account and look through the offers. Also, to finalize, basically, Agla told her most loved phrase about markets regarding timing.
Timing is everything.
Yeah, my favorite phrase is.
Follow the trend?
No, not really. Is that fixed income is sometimes neither fixed nor income. So I would recommend you guys always remember that and both participate in the market, but be careful because, yeah, you can get burned and it's your money and it's ultimately your decision. But thanks for being here. Thanks for listening to us. Yeah, we'll leave the stage for.
Thanks a lot for having us here.
Thank you for pointing out that we do need institutional and retail investors. We talked about retail investors and their emerging power and their eagerness to participate in small and medium companies' issues, as Agli did before. So we kind of stepped into the next presentation, which will be about the behavior of the Baltic retail investors. And that presentation will be delivered by Chief Economist at Luminor Bank Lithuania, Žygimantas Mauricas. Let's welcome him on stage. I saw him there last, now he's there.
Okay, thank you very much. I will make an intro, very short intro presentation, 10 slides plus 2, about behavior of Baltic retail investors. And the key question, how do you think, are we more like risk seekers or risk averse? Yeah, Lithuanians were last pagans, so yeah, could be anything. And I start with good news, which is statistics about how our financial wealth is growing, and it's growing exceptionally fast. Over the last 5 years, in all Baltic states, it has been growing much faster than EU average. Lithuania, as it's commonly the case in many other indicators, is leading. Latvia and Estonia is not too far behind. And the good news is that even if our economic growth will slow down, which can happen due to multiple reasons, financial wealth convergence with Western European countries should continue, because in terms of our GDP per capita, we are already at much higher levels compared to our wealth level per capita, because GDP you measure just, it's like a flash, what you create during a single year, and wealth is what you accumulate over the years. Yeah, so you have to be really creating a lot over multiple years to accumulate this financial wealth. And this is especially evident when you see this graph compared to Western European countries, how wealthy they are. And it's like Denmark, Luxembourg, Netherlands, basically Scandinavian countries, Benelux countries, Anglo-Saxon countries has accumulated substantially more wealth than the Baltic and other Central Eastern European countries. But as I mentioned, it's almost evident that we will continue catching up. And I just made a selection of countries, Southern European countries. You can see that in terms of GDP per capita, we actually pretty close already. We actually above Greece already, pretty close to Spain, Italy. But in terms of our financial wealth per capita, actually we are lagging behind. Italy actually has very huge financial wealth per capita, even higher than Germany. Germans actually are jealous, yeah, about this. So they have low debts, but also low financial wealth. So Italy is like not a very rich country, but full of rich people. But Germany is like, yeah, don't have so many. But then comes not so good news. Not so good news is that, yes, we work hard. We create a lot of GDP. Some of this we save, so our financial wealth is growing. But is it growing because we invested wisely? And is it growing because it generates high returns over time? And the answer is not really. We are actually quite conservative. Actually, we are as conservative as the average of Central Eastern European countries. And I also included Bulgaria, Romania, not to look as too bad. So basically, if you look at the composition of our financial wealth, majority of it is in cash, current accounts, and deposits, which until recently, all of them generated 0 returns. Now deposits at least generate some, but I will show later, deposits only constitute a minor share, still minor share of all the assets which are held in the banks, because people just are too lazy maybe or not have incentives enough to put deposits and earn some interest. And the rest actually is not looking that good, especially compared to Scandinavia. We are quite conservative. And I just made a very simplified, not to complicate too much with numbers, graph how on average over the last decade, what return generated average Scandinavian financial wealth portfolio and Baltic wealth portfolio. And you can see that on average, every year, every single year, Scandinavians generated on average, of course, 2 percentage points higher return than Lithuanians. So even if we had 10 years ago the same wealth level, yeah, today we would have been almost 1/4, we would have 1/4 wealth less than Scandinavians, just because they tend to invest more in return-generating assets compared to us. So our risk aversion or conservativeness actually result in slower wealth of our financial assets that has already been accumulated. Yeah, we accumulate them faster because we are growing faster, but with existing capital, kind of don't have time to invest, and as a result, it affects not only each individual, but also on a macro level, global, our balances. And Albert Einstein told once this quote that compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Yeah, so we are more like on a paying side. Yeah, not on a earning side. And we got a cold shower for that because with this distribution of our financial wealth, we entered this huge inflationary shock. And actually our deposits that we held that back then were earning 0 interest rates actually were eaten quite a lot by inflation. So this inflationary shock increased wealth inequality. We are talking about income inequality. We like to talk about wealth inequality. It's also important. So those that invested in return generating assets, be it financial assets or also real estate, they actually even increased their wealth in most cases, even in real terms. Those who didn't, their wealth actually declined. And as I mentioned, even now, with interest rates jumping quite fast to pretty decent levels, transferable deposits actually still account for the majority of our financial assets held in the banks. So basically, as I mentioned, people sometimes even forget maybe to earn, or they just don't have time to earn extra interest. So there is no tradition, there is no awareness, maybe there is no financial literacy. And I made, it's already 7 years ago, research. This was my, I had to do it because I graduated from executive MBA. And I did a survey of respondents. So they self-evaluated their financial literacy in the beginning of a survey, and then I asked multiple questions. And the result is interesting. Those respondents that had weak or very weak investment knowledge primarily invested in real estate. Yeah, all other financial assets were like terra incognita for them, except those that offered some tax deductions, yeah, like insurance. So Lithuanians like this, yeah, especially, yeah. Oh, yeah, I can minimize my taxes somehow or reduce them. So that's what they like. But what they don't like to invest in those assets that generate return. So they like to save something, but they are probably not that excited about the potential to earn more. And obviously, investing into real estate is not a bad thing. It's better than not to invest at all. But as the saying goes, it's not good to put all your eggs into one basket, because you then basically take too high sectoral risk, country risk, and also liquidity is not that high in the real estate sector. So if you badly need cash, liquid, like financial instruments, it's not easy to liquidate your real estate holdings. And also this love for real estate can have negative consequences by rising real estate prices, probably slightly more than they should have risen. Yeah, and the worrying thing, which I already noticed 7 years ago while doing this research, is that actually, which I was actually quite surprised, that during the generational change, it's not changing so much. I mean, elder generation, they don't invest because they don't have traditions. It's pretty new for them. They came through this 1990s crisis, bank crisis, etc. So they are they don't have probably as much trust in financial system. But the younger generation also are quite reluctant. And in fact, when I have like kind of lectures, you can say, or discussions with executive MBA students, I have it on a yearly basis. So only few of them actually are actively investing. Majority of them still don't. And I ask why. Do you have something to invest? Yeah, they say we have, but we don't have time. We don't know whom to approach. If I ask, do you know how to invest in bonds? Usually the answer is no. Very few know. Those that know, they are bombarded by proposals, yeah, because we already have established themselves, but it's still kind of pretty, I would say, terra incognita still remains. And Estonia seems much better in this respect, because you see that the younger generation tends to invest more. So yeah, why it is so? I don't answer, obviously. I leave it for discussion, and the key discussion topic will be about behavior. So is it because we are risk averse, not risk seeking? Is it because there is lack of trust in financial intermediaries? Is it because of lack of traditions? Is it because of lack of financial literacy? Is it because of, in general, underdeveloped markets? So why we are still as conservative as those Central Eastern Europeans, which we, in many cases, are already above in terms of GDP, and we are closer to Scandinavians, but in terms of investing, we are still very conservative. Yeah, so that's my few slides. I will not take long. I'm looking forward for discussion.
Thank you so much. Thanks so much. The discussion will start very soon, and you have sort of opened it up with questions already, but I'm sure you do have your own answer, which I'm going to extract from you now. When you showed the Estonian bit and it was high, and normally when we speak about Estonia and Lithuania, we somehow narrow it down to Catholicism and, religion. Could that also be, the tendencies to risk, could that also be related here? Like, could that be an answer in some sort of way? Cultural traditions, as you say.
I think going to church these days doesn't prevent you from investing, because it's quite seldom that we do. Like once or twice in a year on average, maybe, yeah, or maybe more, some people, but yeah, maybe, like, historically, sorry, but I mean, maybe we are closer to Scandinavians, we get this influence.
And when you say that the majority of savings are still in the bank accounts, has that been fluctuating in any way? Has it been, going towards the no bank accounts, but the other direction?
In 1990s, Lithuanians were quite active, and all other Baltic citizens were quite actively investing, especially in local markets. Yeah. But since we had all those turbulences, crisis, most of them just left this market. Also, the dip was after 2008 crisis, probably because there were some bad experiences, and people just said, okay, if I can lose so much, maybe we hadn't lost, maybe they just, whatever, maybe they just saw that, okay, there's that my portfolio can not only grow, but also can shrink. And somehow there's a group of people probably that said, okay, enough is enough. And maybe Estonia is slightly different. So it will be interesting to discuss.
It will be an interesting debate. Let's gather some more opinions. Do take one of these seats, Mr. Mauricas, and then joining you will be Vice Minister of the Ministry of Finance of the Republic of Lithuania. I think it's high time you went there.
No, I'm waiting for others to choose.
Others will join by the Česnulevičiūtė Markevičienė from the ministry, and then founder of F10 Capital, Viljar Arakas, will be joining you too, as well as chairwoman of the board and chief of strategic growth at Profitus, Viktorija Čijunskytė. The panel will be moderated by chief economist of Šiaulių Bankas Group, Indrė Genytė-Pikčienė. Let's welcome them all by giving them again a very big hand, and the floor is yours. Do have a fruitful discussion.
invite Inga Milinienė from SEB and Andrius Šuminas from Swedbank. Please join our panel. Hello, good afternoon, everyone. The patient ones. Thanks a lot for that. I am truly grateful for the opportunity to chair and to moderate this panel, this distinguished panel, the last but far from the least, the cherry on top. And I sincerely hope that our insight and views will be thought-provoking and valuable to all of you. Also, I would like to energize a bit the audience. Be brave, raise your questions and hands, and participate in our discussion. I, together with the organizers, will do our best to make those questions answered. Yeah, but without any further hesitations and pleasantries, let's move to our topic. Let's go closer to our skin and deepen into the situation of the retail investors. Thanks, Žygimantas, a lot for the warming up the stage for all of us. Very good presentation, very good marks, but however, a bit of a different ambition our topic is charged with. Because, well, what I saw, what I heard that, well, our Baltic households pursue a rather conservative strategy. Liquid assets, it's a bit of terra incognita. So that raises a bit of worries and also distinguishes us from the rest of the developed economies. So my first question would be, do the rest of the panel agree to those conclusions? And what do you see? And how could you measure the gap of the Baltic economies, of the Baltic retail investors in comparison to the rest? Inga, please break the ice.
Oh,
Yeah,
okay.
super.
Break the ice, to say. Okay, so nothing new actually. I mean, each of the panel already actually touched the subject on the education and the self-awareness actually about the investing. So probably just will chip in here as well. But we a lot at the bank we discuss on the subject, how to actually also to increase the awareness, the financial literacy, as well as encourage people to start the investment journey. And when we touch upon the subject, I always try or like to break down the subject in 3 pillars. So the one being that the most important one, and which has been discussed very widely in today's conferences, how to increase this awareness, financial literacy, and so on. And actually, you know, the trend is quite positive, but also on the other hand, there is so much work also needs to be done. So I was really also surprised when the Bank of Lithuania, in fact, in spring has done this annual survey, which showed that about only 39%, I think, of the society, they think that their financial future actually in the hands of someone else, but not so not on them actually. So someone will take care of a financial future. So and also at work, we very often come across with many clients who also they mixed the investing with the saving. They think like it's pretty much the same, which obviously is not. But when we mention that the investing, so they always think it's like it's something gambling, is something suspicious, is you know, that they don't literally have like a clear goal why we need to invest and what that can bring, and so on. So we still think that people think that this mystique surrounding about investing is only for the wealthy people, for the people who have like a lot of capital, for the high net worth individuals, but not for the retail investors. Also, the second pillar would be, which is very important, is regulatory framework of the government effort. Obviously, the tax incentives very much helps. But on the other hand, there are some of the things which still needs to be done, such as obviously we are very close to having an investment account, which hopefully is going to be a big plus, but also there are some of the other burdens, such as, just maybe one example due to the time limits, such as we feel like sometimes the investors, for example, hesitate to invest, especially when they have the families, and if you at some point you want to redeem the investment, so you need to get like a spouse's validation, a formal validations, and there are so many times it happens when that distracts or pushes the decision not to invest at all. And the third one pillar would be the supply of the different instruments in the market, which I think is we are on a positive trend, and as never before we've seen so many different ways of investing, whether it's going to be bond, equities, ETF, you name it. So I think that part of the pillar is a more positive trend.
Yeah, thank you very much. Anybody would like to elaborate a bit on this? Yeah, you should start speaking.
Maybe I can add that we need more success stories. Because I remember when I sometimes discussing with my parents, they remember the Soviet Union when they was accumulating some kind of life insurance. I know what was they're putting money, and one day the banking doesn't work. Not working. Now? Okay. Now it's okay? Okay. So I'm trying to say that we need more success stories, because I remember when I'm discussing with my parents about investments, and every time I'm saying, we need to accumulate, to put some kind of insecurities, not keeping on deposits, they're saying, Andrews, I remember that stories when I was accumulating, using it like kind of life insurance product was maybe in Soviet Union and so on, and everything is gone. For them, it's like, when you can buy real estate, it's mean for them like, I have a brick. I can go, I can see, I understand, and I have it. So I think the success stories is most important because, we're now talking about accumulating and so on. Of course, it's take a time, but I think when one day we can say not like you're accumulating, but show that, look, you was doing long time, we see compounding interest rates and so on, and now you have pretty accumulated amount, you have successful pension and so on. So it will take a time, but I think one of that is more important to show this good stories and to have it.
Yeah, very good point, actually. Yeah, we lack trust. Our experience is a pretty short one comparing to the developed world. So yeah, it takes time. Okay, Viljar, a question for you. Do you see any differences among the Baltics? Because often we are assumed as a one region with similar specifics. However, digging deeper, we see a pretty different picture.
Yes, hello. Is it working? Yeah, I hope it is. In Estonia nowadays, when you follow economical news, everybody speaks about Lithuania. And what has happened to us, the Estonians, who used to be the front runners for 30 years, Harju County, whereas the Tallinn is the center, used to be the largest, or the GDP per person was the highest in Baltics. Now it's the Vilnius region, so congratulations. But one thing where we are clearly ahead of you is the capital markets. And I've been thinking about it because we have two funds listed in Nasdaq, and I've been thinking, well, why it is like this. And clearly there is one thing, this our business newspaper, Äripäev, created this artificial guy called Investor Thomas, who started to invest 1 million EK, which is in euros 65,000 euros. As a real money, and people started to follow that. I don't know why, but in the Šiauliai Bank, if I'm not mistaken, over half of the shareholders are Estonian retail. And we have in Estonia like 120,000 people who have a securities account at least one share. There is an endless number of blogs, podcasts, everything, and even my 16-year-old daughter came to me, now I need to invest to SEB Artificial Intelligence Fund. One day surprised me. So I think that is just a question of time, because when somebody offered you some investment opportunity in the 90s, it was fraud. 90% of the times. So everybody remembers that, but it just takes time. But that's something where we are ahead of you. But I think that that's a great potential in Lithuania, which should be unleashed. Yes.
Thanks. Yeah, actually, that's right. Estonia is in this sphere is far ahead of us. But Victoria, from your perspective, are those Lithuanians so conservative? Your asset class you are working with is not a bit. It's new. It's brand new. It's going through the first business cycle. So, what kind of retail investors do you meet, directly or indirectly?
It is working? Okay.
Super. Yeah.
Hello, everyone. Thank you for the question. Yes, if we're talking about exactly my business, real estate crowdfunding, it is indirect investment in real estate. But we need to be clear that it's not direct investment in real estate. It's investment into the loan secured with real estate. So I'm happy that now people understand that and they see difference between investing direct into the real estate, like ownership for rental or for some flipping or some buying to land development, and difference more like passive investment with real estate collateral into the loans. We were working for 6 years already with financial literacy about what does it mean investment, and all platforms together during the 6 years made a great job, and we see that now investors understand and they see that investment opportunity through crowdfunding platforms or peer-to-peer platforms as an option, very easy way, digitalized way to invest small amounts. And if we're comparing direct investment into real estate and indirect investment, why people turn that way? Because it's more accessible, because they can invest small amounts from 50 euros, 100 euros. Other thing important that it's easy and digitalized way, and we see and we work on that younger generation started to invest more. So we have investors from 13 years, we're working with 16 years younger generation, and we see the future there. But most investors are from 25 up to 45 years. If we're talking about their average portfolio, it is around 6,000 euros active investment.
Thanks. Yeah, well, actually, it's one of the opportunities to touch the real estate, because recently we have experienced a pretty expensive boom of real estate here in the Baltics, and the question touches the affordability. The Baltic retail investors would like to invest into the real estate, but actually the affordability levels have shrunk. So, Žygimantas, do you see that this macroeconomic condition will trigger or fuel the shift into more liquid investment assets?
Yeah, I think it's already shifting, but maybe not as much as it could be, because what I see again from this experience, like case study based. If you like from finance field, usually these people invest. If you're like from arts, from like like other not related to finance fields, then it's quite challenging to start investing. And these platforms like Victoria's is doing probably a very good job in breaking this first ice. I mean, people start. Like people get a chance to see that it's not that difficult to start investing, because they are kind of this first step is probably the hardest to make, yeah. And then you get many questions. Are you sure you want to invest? What's your risk appetite? And whether nobody asks, are you sure you want to keep your money under the pillow? Yeah, it's just by default. Yeah, and as mentioned, since real estate got more expensive, people, I would say, they
they would wish to start investing with smaller amounts. So this is a great opportunity, and Lithuania actually is leading in the Baltics in this field.
Yeah, that's promising then.
I would add just a little bit. We do surveys with our investors. They need from 6 to 12 months to make a decision to invest. So the most important thing for investors to make that first step is knowledge. First thing is knowledge. So we all together, we need to work a lot with financial literacy.
Yeah, that's a very good topic, and I wanted to touch it just right now. And the following question of mine goes to Vaida, and I would like to ask how governments can contribute to higher literacy among retail investors and to initiate them to choose more diversified portfolios and investment decisions.
I think that
Micro doesn't work.
Let's try with this. Okay, this works. So I think that financial literacy is really a key thing, because we do start from the very low base. If we take EU average households, there are 17% that invest directly into like shares or bonds, and 17%, it doesn't seem like a very large number. If we look at the US, there are 43% that directly own shares or bonds. If we look at our market, so last year's data says that only 2.3% of households invested directly, not like through pension funds or something like that, but directly into security. So the number is really low, and if you follow the discussions from the morning, we understand that we need also funds in the economy to fuel our businesses, to fuel our economy, to ensure that they have enough money to kind of grow, and investors can be part of it. So I think from the state perspective and the aspect that was already mentioned, the first step. So I think that is very important. So once the people do the first step, be it like peer-to-peer or crowdfunding or any other type of investment they understand, it is already a good thing. And we also, as a state, we offer safe ways to invest. So one tool is our government saving notes that were kind of revived last year. We have like 250 million euros collected through those notes. So they show the first step. Also, from 10th of October this year, people will be able to buy our kind of defense bonds. So that is also a way to kind of enter the market, and there is a discussion about kind of return rate of defense bonds, and defense bonds are not about the return in the first place. They are about people being able to contribute to our national defense, but also I think it's making a first step to go into the financial markets. That is very, very needed, and maybe after trying that they can try other things, and this way they could earn money on their savings. And I would maybe understand if we had a debate, is it better to invest in like one type of investment or the other? But if we look also at the kind of money lying around just in the current accounts, we have 23 billion euros. So it doesn't mean that they are even in like term deposits that do earn any interest rate. So there is zero. It's even minus, because we have to kind of discount the inflation. So we have such large amounts of money lying around, not working in the economy, and that's why we gathered the group of institutions, academia, NGOs, and the market, and we made a financial literacy plan. And it has 3 focus areas. So one is children in schools.
The other one is general society, and the third one is also business, because when we talk about Lithuanian capital markets, we have this egg and the chicken problem. So we thought that instead of debating what has to come first, investors or the kind of instruments to invest in, we decided to work on both of the areas in parallel. So I think that kind of focusing on all the different groups, we can ensure demand and supply, and also having people understand, like having more literacy will help them to enter the capital markets and make more informed financial decisions, because even when people are not making any investment decision, keeping the money under the pillow or in the account, they do make a financial decision that has a cost for them. So it's better that there would be an understanding of what is the value of money and how can they work better. So our financial literacy plan also will have the council that will monitor how it is implemented, so it doesn't end up in the drawer. And we hope that it will produce tangible results. And when we talk with the market, I even hear very ambitious plans. So if now the number of people investing don't reach 100,000, we have an ambition to have 1 million from the market. So I really hope that the market will really kind of contribute in bringing those investors on board. And what we did, we helped to make the process easier with the investment account that was already mentioned. So it will be an easy tool. People will have an ability to invest and only have to pay taxes once they use the returns. They can invest for like 5, 10, 15 years without having to kind of pay taxes. They just need to say to our tax inspection that they had this investment account. If we have profit, if they have loss, they can kind of offset once against the other throughout the period of time. They can have as much investment accounts as they want in any jurisdiction that has an agreement with Lithuania, so of course EU, EEA, so kind of very broad jurisdiction. So hopefully that will also encourage, but of course only that is not enough, and everyone has to contribute and do their bit in order for this to work. But we do see a value. We see a value for businesses, for the economy, and of course for our people that can earn interest on the money they have.
Okay, thank you very much. Viljar, is this financial literacy in Estonian genes, or you somehow educate your children from the birth to become such a beautiful investors?
No, we are all the same. I think Estonians, Latvians, Lithuanians are all the same. But what we have, and it's quite fascinating to see, we have this army of, what's the term, finfluencers, who constantly blog, I don't know, make podcast about what they buy, what they sell, how is their portfolio doing. So they do it very openly, and that is really picked up by younger generations. So the Generation Z is really active on this level, and my friends also, whose children are, let's say, teenagers, we are all amazed how much they already know about it. So it seems like they're getting this information from somewhere. And then when we have asked, then it's exactly examples, and these influencers who you cannot create by government, who just pop up, are really shaping the market in Estonia.
Are they shaping the market in the right direction? The question is.
At the moment, we have a very big blow up in Estonia of one startup which was renting cars in South Africa, where one of the biggest influencer invited 600 people to lend money and even didn't pay attention where the money is going. But cases like that are really needed, because you learn nothing from your success. You always learn from your failures. So that's a public failure at the moment. It's heavily discussed in all media outlets in Estonia, and those are really needed lessons, because when you buy something, it goes up, then that's how it should be. But actually, when you lose something, then that's the place where that's the only place where you learn something from.
Maybe I can chip in a little bit.
I wanted to invite you.
Yes, so governments should do a lot as well, but also at the same time, my own experience shows that, at least in Lithuania, I can speak for Lithuanians, but the people really like to relate, and they like to relate to their neighbors, to their friends, to, you know, to someone who they remind themselves. So currently we are at the bank, we're running one project. I won't mention which one, but we're running a project which is kind of the same you had, I think, in Latvia, whereby we have 3 investors, one of them being a retail investor, unexperienced, he hasn't invested anywhere before. So the other one is the professional investor. She's a fund manager. She has a lot of knowledge how to invest, where to invest, and so on. And the third investor is this robotic kind of solution. It can be anything, literally. It can be Revolut or whatever. It's just an app. And each of those investors, every month, they get 100 euros, and we have to make a decision based on who they are, literally, what they know, what they understand. And what we noticed that, most of the retail investors, obviously, they relate themselves to that person who hasn't got an experience in the past, and they can see, how he's actually, how he makes decisions based on what type of questions he's raising, why he's succeeding, why he's not succeeding, on all of the failures and successes. So I think the more we share about that experience, something what you said before, so the more the people can actually relate. And as I said before, mostly people relate investment with something big and wealthy and ultra wealthy people can just do that. But then if they can relate to the people like themselves, so they can make that first move and first decision. And after all, people should invest in the things which we understand clearly, minuses, risks, and advantages, disadvantages. So that's the ultimate goal, obviously, before they make that first step into stepping in the investment world. But as long as they step in.
Yeah, before Vaida, I would like Andrus to contribute a little bit on what's the role of financial intermediaries, of banks, in this financial literacy journey.
I think we are very active. We had a Swedbank. We're using this Maconomica. We're preparing every year one day educational thing for the kids and so on. I'm really glad what was also mentioned about this. But we need to provide also more information, because we have a lot of instruments and so on, and sometimes we need the guidelines, because sometimes, it's information, recommendation. I'm really glad about these influencers and so on, but should be some kind of restrictions. And, I'm really glad that still our new generation are really investing. We are interested, we are discussing and so on. And I think one is important part, so it's good, when you're a young one, you still have a small amount of money. So in my opinion, to take at that time risk, it's okay, because if you lose, you will lose a lot less money, but you will earn a lot of information. And I think that your most important part of that is investment, your educational part. So, and like a Swedbank and other intermediaries, we are doing a lot, but of course it takes a time, because I said the same, but we need more success stories and so on, because someone you are saying, look, it's possible to do that and so on, but someone said, look, but I know that story. Some kind of stock goes down, 80% down, and I'm not interested because I don't understand that. So it's take a time, but I think we're pretty active.
Thanks, Vaida.
Let's try this one. Okay. I heard an interesting aspect that the perception is that only kind of wealthy individuals can invest, but then for me it's such a kind of dissonance with the most popular investment class in Lithuania, which is property, because to kind of buy real estate, that requires way much more money than invest into the stock market. And when we look at those who can invest in the property market, I think 20% of individuals have more than 2 residential properties, and of course we can discount that some of them are like summer houses, not for investment purposes. Only 4% have more than 3 residential properties, so it has more likelihood to be of kind of investment stage, and just 1% has more than 4 residential properties. So I would say that is really something that not everyone can afford, and even those who kind of have a dream to invest in real estate, they do need to accumulate the funds, and they can keep those funds just in their account, or we can invest. And you probably know better what are the kind of amounts that people invest, but I think they can start with even like 2-digit numbers amounts and just test the market and do what they understand.
Yeah, yeah, that's right. We're coming back to this affordability aspect. Žygimantas, the question for you: what kind of external circumstances or factors or macroeconomic factors could fuel this shift from real estate to more liquid asset classes? Or maybe current situation.
Yes. I don't want to talk about it too much, but yeah, basically with geopolitical uncertainty, increasing geopolitical uncertainty is one of the factors. People are looking for ways to diversify their portfolios, to have their financial wealth in more liquid forms. But of course, we ask many questions. This is also like, what can we do about this? I'm not so sure, because we say, okay, let's assume I invest, and then what happens if something goes wrong? How can I access this, etc., etc. But I think this, in general, is one of the existing incentives that are pushing people, and the pulling factor is a technological change, where you can really using some app. You can really invest. If you don't know what you're doing, then you can ask a friend who is doing and copy him, or ask for his advice. So this probably, I hope that this will eventually accelerate this, because the first step, as I mentioned, as I see, it's really the hardest one, because we have people that are completely out of these topics. They have money, but they are, especially those that are from different segments. So it's like terra incognita for them. I mean, they just say, investments. I mean, no, something, it's not for me. It's not for me. The real estate is, yeah, okay. And that's it, basically.
Yeah, well, you touched geopolitics. That's a pretty burning feature, our financial and macroeconomic environment versus
maybe also taxes, real estate, if they will be,
yeah.
if they will ever come.
If
I'm not so sure
ever
about
be introduced, yeah. Villager, how about your sphere and the real estate market developments react to geopolitical tensions, and how retail investors act in such circumstances?
In our business, as I'm a fund manager, we always lack one or two things. Is it the capital or the projects? And at the moment, we're in a phase where we lack capital. Actually, this geopolitical situation is playing in our favor. A lot of foreign investors are leaving, and the reasons behind it is not geopolitical. They have their own troubles at home. Especially Scandinavian ones, especially from real estate sector. So they just need to sell assets in their, so to say, periphery countries for them to keep their home turf secured. And it creates a lot of opportunities for people like us. To raise capital can never be easy, and if it's too easy, then it's probably wrong time. So that's why in Efton I'm actually feeling very positive where we are at the moment. Nobody wants to invest in real estate. That's the time when we usually make the biggest moves. And during the COVID time, when everybody wanted to be over there, then it's reminded me so much 2007 and 2006. So we didn't do anything, and we were just sitting on our hands at this time. So actually, it's really time for our local people to come and grab some of the assets which are left behind by foreign investors. And we have a lot of funds like us, so we have competitor funds who are able to make it happen. So I see the future going forward very brightly, actually, especially now when the Euribor is falling off the cliff.
Okay, Victoria, what's your view on this? Do you agree to that?
I will tell you our story, how it happens when the war started. We put at the same day 500,000 project on our platform, and I woke up in the morning. So I was sitting like that and was thinking, what we're gonna do? And in 4 days, our retail investors invested all amount, and we were all surprised. But at that time, so that's I heard in the previous panel discussion that retail investors are unexpected more than institutional investors. But at that time, high net worth individuals, family offices, and institutional investors really stopped to do any move. And some colleagues from other companies started to call me and say, "What's happening? Why in your platform still everybody investing?" So I was really happy, but we know that it was because of the trust. After several months, the inflation started grow very fast. What happened then? Everybody were afraid of the war, but still they wanted don't lose their money because of inflation. And they started to call to me, to my colleagues, what to do? I want to invest. And they started again invest. But it was very, very cold winter, this winter, when everybody were really afraid and the people were not buying real estate at all. We saw a drop of real estate transactions, and at the same time, retail investors were very slowly with their decisions. So, but now I feel like more spring at the moment in investment field, and everybody is starting now wisely invest and choose where to invest. And why people choose a more liquid investment and indirect investment in real estate, I agree that some people are afraid and stop or not making decision to buy directly real estate because of geopolitical situation. And as everybody heard about, everybody invest in Spain. Yeah, and I was thinking that it's rumor, but it's not. They are really buying real estate, and their taxes of buying real estate are 5 times bigger than in Lithuania. But still, they all want to have Plan B.
Yeah, well, we all are hearing every day those stories. Okay, I would like to turn to Inga and Andrius and ask several questions about those investors, not so much of a retail, but who are informed, who form their portfolios with high financial literacy. What are major trends in terms of private banking?
Okay, so if we're talking about private banking, if we're talking about Swedbank, I think at like 60-65% of all assets are invested. So there is still potential to do that. But if we're talking, the shift main was like the main 2 years was a bonds. Why? Because what Vilmar was saying, real estate is really a big part of investments of your portfolios and so on. But when rates start increasing and, someone's asking to attract equity and so on, but they're saying, look, could be investment, maybe a return 12, 13%, and someone is providing bonds for 10, 11, 12% and so on. So he's choosing a bond. So we're talking still from our part, I think like 40% of the bonds, mostly. A lot of course, clients are buying by the locals. They're doing by themselves. I mean, there is a lot of issuers, what was Egle showing from Šiaulių Bankas and so on. Another part is equity, but reality and what I see, what now interest rate is decreasing. So we see that clients are starting to invest directly to real estate, indirectly. It's a question when we're talking about retail, still in Lithuania, and I think in the Baltics, there are a lot of funds when you can easily to invest indirectly to the real estate, but still it's mostly informed investors and so on. So, if we would like to do that, so there's maybe, I don't know, in stocks exchange, maybe 2 or 3 funds, it's possible to do that. I mean, from the small ones, but of course there is a profit on a different part. So, but mostly the bonds are ruling now.
Okay. We probably need to distinguish, obviously, private banking or high net worth individuals and retail. When we talk about retail, so it's more about like how to accumulate and grow their capital. When we talk about the private banking, obviously, we are talking about the people who have already accumulated their capital. And as I think I heard somewhere in the previous conferences, then with money you have a problem in two cases: when you have money and then you don't have money. So in the private banking, obviously we're working with people who have money, and therefore our strategy is to focus on how to preserve their capital and obviously grow step by step in the longer term. But we notice as well that and working with high net worth individuals, so these are the people who are either sold maybe the business, they accumulated the capital through different means, but they don't want to jump between the different strategies, make irrational decisions, or if the market, for example, is down, let's change something quickly. So the discussion and the dialogue is completely different when we are dealing with the retail investors, working partially as psychologists as well and educating what's happening with the market, and then that you need to calm down and you need to wait. The high net worth individuals in a private bank is more about like, okay, this is the strategy, let's stick to it. Yes, in terms of either it's a bond or equity, it's pretty much probably the proportions are very, very close, but it's private bank is about the long-term strategy, how to preserve a capital and grow over time, and how to have a strategy which would overcome or withstand all the inflationary type of cycles or any other economical challenges which can come across.
Yeah, thanks. And Vaida, I want you to elaborate a bit on this topic. Andrews touched that, high interest rate environment triggered off and opened the window for the wider variety of asset classes to shine, and we see how retail investors are becoming eager to decrease interest into this asset class. But now we see the different trend. The interest rates have started to decrease, and will it be enough just to trigger off this shift from real estate to a wider variety of asset classes and more diversified portfolios?
So I will return to my previous idea that there are, I would say, very few households or individuals that can afford to kind of directly invest into the real estate, even though if it's very trendy, very popular. But if we look into the numbers, I would say everyone could invest into the capital markets, because it can be done even with small amounts. They can use different tools, different technology. It's a very liquid instrument if they can invest just for even few months or something like that, while real estate is a kind of pricey and long-term commitment. So I think that the interest rate environment shouldn't influence so much those people that are financially literate, because if we look at the EU, if we look at the US, these instruments are something that they do hold in a very kind of as society, as a very kind of broad way of keeping their savings. And from the state perspective, I think we are creating the base for it to be kind of easy and affordable and understandable. And also, I do have a hope that also our kind of younger generation will be more attracted to capital markets, because very soon green finance instruments will also become a kind of new norm. And looking at their kind of habits, it can motivate also them to enter the markets, because then they are not only investing but also do something good for the environment.
Thanks. Now I am turning to the audience. Maybe there are some questions. Do we have? Okay, super.
Thank you. Amazing, this works. So, average salary in Lithuania, 1.4K net. For the sake of mathematics, let's assume person puts away each month for investing 100 euros, which is close to 10%. So compounding that after a year, 10% market return, it's 1,200 plus 120 euros. how can we make to the average person investing, let's say it's sexy, because these returns and average person, they are not interested in investing in such small amounts. They rather spend it on something tangible like a vacation or something. So financial education is beautiful and I'm all up for it, but how can we present that to an average person with a salary of 1.4K net? Thanks.
Okay, so who would like to take this one? Žygimantas? No?
Just very short, I was just referring to this high net worth individuals. Maybe we can start from them. I feel like if they invest only 60% on average, even sometimes less, then it's still lower than Scandinavian average. So even if you're high net worth, you're still like more conservative, and this probably is a bulk of financial savings that accumulate to them. Yeah, but this is like difficult question. I sometimes not answer to the question directly. So I leave someone else to answer.
Okay, who will be the brave one?
So I think if that person who earns 1,400 euros puts aside 100 euro, so that's already a big step. We actually notice in the bank sometimes people are so cautious and don't really trust anything what relates to what investment. So we start even investing with 1 euro, and we notice like they put that 1 euro and they wait. They open an app and see it hasn't gone. So actually has like 2 cents on that 1 euro or something. Okay, they put 2 euros. And then eventually we have like some success stories. We end up with 5, 10, 100, and 150. So 100 euros is already a very good start. Actually, it's better than nothing.
Yeah, definitely. I would agree with that because small steps. This is not a sprint; it's a marathon, and you need to start with small steps. And when you see the return, you will get appetite for more. Yeah, so on this note, I would like to round up our nice panel. Thanks a lot for listening. Thanks a lot for panelists. And we'll be all waiting for the beautiful networking session. So have a relaxing one. Thank you very much.
Thank you so much. The session will start soon. However, if we could take a few minutes, I will do a bit of a summary of the whole day in case you have missed some of the panels and some of the bits, and just to have a brief overview of roughly what has been said. So we have heard about the future from the central bank's perspective in the morning. It will be more digital. Regional proximity borders will become less relevant in the future. Rapid growth of digital services, that will obviously cause risks. Investment into risk management will be key as well. Supervisors will be technologically neutral. Expectations from supervisory authorities will still be there. Cyber threats, the significant improvements in terms of money laundering have been promised by the central bank. And then we moved into the panel number 1, the first panel that kind of set the stage, set the landscape for further discussions. We have determined that European capital markets are relatively well developed, from 6 to 7 out of 10, with an upward trend in the future. Lack of risk culture and fragmentation as the reasons why. Current state of private investments, mix of measures needed, maybe a mix of tax incentives, simplification, lowering fragmentation, more institutional investors to be included. Sustainable finance in a pretty good shape in Nordic-Baltic region. Measuring and reporting should be improved. More investments into R&D, technology. Nordics are the leaders there. Capital market integration is important for monetary policy for reasons like more innovative investment opportunities, higher potential outcome, more monetary policy space, and so on. Risk sharing as well. We talked about pension systems that failed in Estonia. We have said that the Estonian population is now more dependent on state pensions, but there are lessons to be learned from Estonia. For example, a regulation of pension funds is critically important. Boosting return from second pillar pensions is important too. Some have said that benchmarks should be more ambitious and young people should invest more in equities 2022 to increase investment into capital markets. Financial literacy plan is crucial. We have repeated that many times over the day. And fragmentation in the first panel was named as the most recurring topic. It needs to be reduced, but as has been said, building capital market union is more difficult than building a banking union. If we stay fragmented, we have a lot of nothing. If we reduce fragmentation, we will have a bit of something. We did move to the panel on IPO, and we have basically said, I will very roughly conclude that scarcity of investors, most of the speakers believe that it is a scarcity of investors rather than the scarcity of candidates. We, meaning Lithuania, got some advice from Vinted to be more physically accessible for investors, to transfer the success story of fintech and startups to capital markets. We need to be more aggressive, have the right ambitions as society, provide more regulatory incentives. We have then said that retail power is increasing, retail investors becoming more active, as has been delivered by Šiaulių Bankas, eager to participate in small and medium companies' issues. Challenges for issuers and investors are small market size, liquidity and depth, macroeconomic risk. Key trends in the Baltic capital markets: the rise of green bonds, real estate dominance, local banks, prominent bond issuers. Liquidity remains an issue as well. Baltic issuers are improving their reporting. And then we moved to the high yield debt panel, where we said that market is growing. We need both institutional and retail investors. The advice for investors: read, educate yourselves, don't be greedy, and diversification. And basically, we have said that yield combined with inflation and other aspects are indeed answers to Baltic high yield debt market. We have heard from the economist, he's no longer there, Žygimantas Mauricas, a piece of good news and bad news. I will just remind you of it. The good news is that financial wealth is growing exponentially fast in the Baltics, in the households. Even if the economic growth slowed down, financial wealth should still be continuing, as wealth is something that we will have accommodated throughout the years. Bad news is that Baltic households pursue rather conservative investment strategy. We have not learned the inflation lessons. The majority of savings are still in bank accounts, no financial literacy, very few invest into publicly traded securities. For most of them, it remains terra incognita. And then this very last panel, I will provide you with a brief summary too, even though you were there as well. Yes, it is time for households to switch from real estate to liquid financial instruments, but to boost that, we need more success stories, we need more knowledge, we need more experience sharing. Everybody speaks about Lithuania on Estonian news, but Estonia is ahead in terms of capital markets. And one of the reasons may be finfluencers, the finfluencer culture, which is strong in Estonia. First step is a major milestone in order to step into the world of investing. This is if you're a retail investor. Geopolitical situation is fueling the investment into more liquid financial instruments. Technological progress is a factor as well. Euribor is falling off and the future is very bright, as one of the speakers have said, but then everyone can turn to capital markets. Interest rate environment should not influence financially literate people, as the ministry has said. Green finance instruments will soon become a new norm, and defense bonds are a trendy new proposal in Lithuania. My key takeaway is that in this audience, Draghi's report is everybody's favorite piece of literature, so do read it before going to bed tonight if you haven't done so. And that was my very rough summary. I thank you very much for listening to it, for being here today. Do share a glass of wine and share your takeaways right there. Thank you for joining. And let's declare the Financial Markets Conference closed and have a nice chat, everyone, and see you some other time. Thank you so much.